Good evening, friends. Today we are going to take a super fast revision of Ind AS 115, Revenue from Contract with Customers. This is one of the most important standards for your syllabus, CA or CMA final syllabus, and in every exam you'll get a question on Ind AS 115. In order to understand Ind AS 115 better, the presentation part, you can purchase this book called Summary Chart from our website vino.in. The link is provided in the description box below. This book covers in chart form summary of every chapter. So you can go for this summary chart book, or there is one more very good book for our student, and that is compact book. This compact book covers your entire syllabus in few pages in simplified format, summarized format, easy to read one day before the exam. So I would request you to have this summary chart or compact book with you so that you can understand better. But for the time being, you can just follow the presentation and you'll be able to understand. Remember, this is a super fast revision, so in 1 hour we will try to give you complete idea about Ind AS 115. We are not going to solve numerical questions today. If you want more numerical questions for practice purpose, we have a book called Compiler. In this compiler, chapter wise we have given questions of study material, RTP, MTP and past exams. So you can purchase this FR compiler from our website vino.in, where you will get all questions asked in study material, RTP, MTP exam chapter wise. It is very useful book because nowadays most of the questions in the exam are from institutes publications only, most of the question, but not all questions. So you can find all question and their solution in the compiler book. Okay, so here we will go. If you have any query, any doubt, you can message me right now, or you can message me later on our email ID. This official email ID asfoundation1@gmail.com, and my personal ID is vinod_ca@yahoo.com. Also subscribe to our YouTube channel AS Foundation, because now we are going to start a series of super fast revision on most of the important standards. So I will try to take this revision on most of the important standard, if not all. Okay, so thank you very much. Let us start this amazing journey of FR revision, starting with Ind AS 115. So first we'll check the scope of the Ind AS 115. This standard is called Revenue from Contract with Customer. It applies to all contract with customer. It applies to all contract with customer, but it does not apply to lease contract. There is another standard, insurance contract, another standard, financial instrument, we have other standard, and certain non-monetary exchange. Non-monetary exchange means exchange of goods for goods. So certain non-monetary exchanges are also not covered by this standard. Before we proceed further, let us have a look at some of the important definitions, like definition of a contract. Contract is an agreement between two or more parties that create enforceable right and obligation. So it is a contract which is enforceable by the law. Then customer. Who is a customer? Because the name of the standard is Revenue from Contract with the Customer. So the party, the other party, the counterparty should be the customer. So customer is a party that has contracted with the entity to obtain goods or service that is the party who wants to buy goods and service which are input of the entity's ordinary activities. It should be ordinary activity, goods and service produced in ordinary activity in exchange for consideration. Then it is called customer. Now we'll come to definition of revenue. Revenue means income arising in the course of entities' ordinary activities. All income are not revenue because only income arising from ordinary activity will be revenue. Income is a wider term. Income means increase in the economic benefit in the form of inflows or enhancement of asset or decrease of liability that result in increase in equity. So for a company, dividend can be an income, rent received can be income, but may not be revenue. Then we'll discuss standalone prices. Standalone price means the price at which goods or service will be sold separately to a customer. This concept of standalone price is required when two or more products are bundled and sold together. In that case, the standard would require you to allocate it on the basis of standalone prices. Now next is performance obligation. The standard would require you to identify performance obligation. What is performance obligation? So performance obligation means a promise to transfer to the customer either a distinct or a bundle of goods or services, a series of substantially the same goods or services. So either it can be one good. So I sell you one mobile phone if I am a mobile phone dealer, or you have given me an order to deliver 2000 mobile phones. I may deliver it over a period of time. Per month I may deliver 100, 200. So a series of substantially the same goods or service that have the same pattern of transfer to the customer, and the pattern of transfer is both over time and represents the progress towards complete satisfaction of the performance obligation, like delivering goods in lots over a period of time. This standard is called 5-step model. It gives you that revenue should be recognized by applying the principle of 5-step model. What are these 5-step model? Step number 1 and 2 is to identify the contract with the customer and identify the performance obligation in the contract. Step number 3 is to identify the transaction price. Step number 4 is to allocate the transaction price to each performance obligation if there are more than one performance obligation. And the step number 5 is to recognize the revenue when each performance obligation is satisfied. So as and when performance obligation will get satisfied, the revenue related to that performance obligation will be recognized. So if a car dealer has to sell car also, provide after sale service also, warranty also, so there are 3 performance obligation, and accordingly the revenue is recognized when each performance obligation is satisfied. Now we'll discuss in detail what are these 5 steps. Step 1 is to identify the contract with the customer, because the name of the standard itself is contract with revenue from contract with customer. So what are the features of a contract? Under Ind AS 115, the contract can be written but not necessarily. Contract can be oral also, or sometimes the contract can be implied by an entity's customary business practices. So oral, written or implied. As per Ind AS 115, it requires that contracts should have all the following attributes. First is contract should be approved by both the parties. The seller and the customer both should approve the contract. Second, the rights and payment terms regarding goods and service to be transferred can be identified. So rights and payment terms are identified. Third is the contract should have commercial substance. That means contract should result into change in the cash flow to the parties. That is commercial substance. And it is probable that the consideration will be received. That is considering only the customer's ability and intention to pay. So if these conditions are available in a contract, then this is a contract for the purpose of this standard. Can two or more contracts be combined? Can two or more contracts be combined for the purpose of accounting? The answer is, if following conditions are satisfied, then two or more contracts can be combined as one contract. The first condition is contracts are negotiated as a package. So all contracts which you have to combine are negotiated as a package with a single commercial objective. And second condition is the contract for each contract is interdependent on the other. The price of one contract is somewhere interdependent on the price of other. And the third condition is they represent a single performance obligation. If these three conditions are satisfied, then contracts can be combined for accounting purpose as one contract. Then what is the meaning of contract modification and what is the accounting treatment for that? So first contract is to construct a building. The second contract may be to construct a warehouse near the building. Will it be treated as a modification or will it be treated as a new contract? So how to do the accounting in that case? The first order was to construct a building. Then the contractee says you add a swimming pool also in that building. Whether it will be treated as a separate contract or a modification of an existing contract. So here I am going to give you the guideline in simple terms, very important for exam purpose. If new performance obligation is added, at standalone price. So this is building, this is warehouse. Warehouse is negotiated on a standalone price basis, on its own, based on current market condition. Then it will be treated as a separate contract. Second is fully unperformed performance obligation is modified. Fully unperformed performance obligation is modified. So if the performance obligation is not yet done and it is modified, then it will be adjusted on a prospective basis. But other than these two, in other cases, any change made in the contract, it will be adjusted on a retrospective basis. That was part 1, identify the contract. We have seen the definition of the contract, when contract can be combined, and how to do accounting of modification in a contract. The second important step is to identify the performance obligation. How many performance obligation the entity has towards the customer. If I am selling my Google Drive pen drive on FR and I have to also give you the study material, I have to also conduct test. So then I have 3 obligations. I have to give you video lecture, I have to give you books, and I have to conduct the test. Similarly, when a car dealer sells a car, he will deliver the car to you, he provides after sale service, he provides warranty. So you can say there are 3 performance obligations. Depending upon the number of performance obligation and when they will be satisfied, the revenue is recognized accordingly. So identify performance obligation. Performance obligation means promise made to the customer under the contract. What are the promises we have made to you? The promises made can be explicit or implied. promised goods and services are identified as performance obligation if such goods and services are distinct. So very important, the performance obligation will depend when goods and services are distinct. Sale of car is one performance obligation, warranty is another performance obligation, after sale services another performance obligation. When will you call goods and services are distinct? Goods and services are distinct if both the following conditions are satisfied. Very important. For a theory question also remember, customer can benefit on its own from such goods or service. That means customer can independently benefit from such goods and service or can benefit by obtaining resources which are available in the market. So a computer is sold and a printer is also sold. So there are two performance obligations because customer can benefit from the computer, and if he wants he can easily buy a printer from the market. So in this case we will call there are two performance obligations, and such goods and services are separately identifiable. So what is the meaning of this last line, separately identifiable? It means goods and services which are promised should not require any integration between them. For example, in construction of a building, there are electrical work, plumbing work, carpentry work, okay, so many other activities which are integrated, interlinked with each other. You cannot get individual services, so they are not separately identifiable. So the items should not require integration between them or should not be dependent on each other arising from customization or other reason, and they should not require customization. Then they are called separately identifiable. Then they will be treated as separate performance obligation. One typical question comes in the exam about the accounting treatment of discount voucher or loyalty point. Nowadays when you go to a shopping mall or even online, when you buy something you also get a discount voucher, coupon, loyalty points which you can redeem at a future date. So what is the treatment for that? I have made a small summary, very useful to you. These are treated as a separate performance obligation. Even when the entity gives discount voucher or loyalty point, it will be treated as a separate performance obligation because you are promising to supply goods or service at a later date at a discount. So what is the accounting treatment? Accounting treatment for discount voucher is first calculate the fair value of the discount voucher. How do you calculate the fair value of discount voucher? Effective discount percentage we will take. What is the effective discount the company is offering into expected future purchase into probability of redemption. This will give you fair value of the discount voucher. In the case of loyalty points and cashback scheme, the fair value is equal to points accrued into value per point into probability of redemption. Nowadays on that TV, Tata New gives you some new coins, Tata New coins. So this is how you will do the valuation of that discount voucher or loyalty points or cashback. Points accrued into value per point into probability of redemption. Points accrued into value per point is equal to cashback. So depending on the scheme, we will do the calculation of fair value of discount voucher, loyalty points, cashback. These values are calculated at inception. These values will be calculated at the beginning, and on every reporting date they are revised because the estimation will keep changing. Its change is called a change in accounting estimate. So if your estimate of probability changes, we will call it change in estimate. It will be given prospective effect, not retrospective effect. Step number 2 is to calculate standalone price at the inception for all performance obligation. Even discount voucher and loyalty point is a performance obligation. So if you are selling a goods of 10,000 rupees with discount voucher, there are two obligations. One is good and one is discount voucher. So you have to find out the standalone price, record revenue from purchase obligation other than discount voucher or loyalty point as per Ind AS 115. So if I am selling this good plus the discount voucher, the sale of goods will be accounted as per Ind AS 115 and discount voucher will be treated as a deferred revenue and will create a liability in the books because we have an obligation to deliver goods or service at a discounted price at a future date. Suppose the customer does not apply for discount voucher, then we will transfer it to revenue when the voucher will expire. Sometimes the loyalty points are serviced by the third party. So I will sell this FR compiler book and I will give you a coupon and I will say you can go and purchase petrol from the nearby petrol pump, show this coupon voucher and they will deliver you the petrol. Okay, so my loyalty point is serviced by petrol pump dealer. Then the amount paid to the third party for compensating the cost incurred is treated as cost of goods sold because that will also be treated as a cost of goods sold towards this book. So step number 3 is determining the transaction price. So dear friends, I'll just repeat, please don't mind. You will find this book FR Compact, which contains the entire theory, you will see in a very nice manner and you will enjoy this book. So kindly purchase it from our website vinod.in, or you can purchase this summary chart book from our website. The summary chart contains the entire Ind AS, your entire syllabus in a diagrammatic format, easy to revise last minute before the exam. Available on our website vinod.in. Now we'll come to step number 3. Thank you Rishabh for joining, thank you Rahul for joining, thank you Prasad for joining, thank you every other student who has joined for this live session on YouTube. So step number 3 is determining the transaction price. It is the amount of consideration. What is transaction price? The consideration an entity expects to be entitled to in exchange for transferring the promised goods or service. The consideration entity would receive on transfer of promised goods and service, and transaction price can be affected by the nature, timing and amount of consideration. Now it includes, transaction price includes significant financing component also, that I am going to explain afterwards. It is like making payments over a period of time, so it might include some interest also. It may have some variable component also like incentive, bonus. It may include some amount payable to the customer also like rebate or refunds to be given, or it may be also including non-cash transaction like goods for goods. So these are the factors which will affect the transaction price. Now I am going to explain significant financing component. Suppose this is year 0, goods are sold here and payment will be made after 3 years, 1 lakh. Will you recognize a revenue of 1 lakh today? Will you recognize revenue of 1 lakh today? The answer is no, because if somebody wants to buy today, he will not pay 1 lakh. He will pay less than 1 lakh. there is a significant financing component involved. It involves interest for 3 years. So significant financing component, if included in the transaction price, we need to adjust the revenue to be recognized. So check, very simplified manner, right, line by line we have written. All of you are requested to understand. Check, consideration is variable. 3 points I will write. Consideration is variable due to reasons beyond the control of the customer. If the consideration is variable for reasons beyond the control of the entity or the customer, for example, sales based royalty. If the revenue is based on the amount of sale, if the royalty is based on amount of sale, it is variable which is beyond control of entity or the customer. Second is delivery of the goods or services at the discretion of the customer, although the advance has been paid. And the third thing we have to check, delayed payment or advance payment are due to reasons other than financing. For example, student says, sir, please send this book to me, I'll pay you after 1 year. I say, sorry, I have a risk of bad debt, you have to pay me in advance. So in some time the supplier insists on making advance payment because he does not want to take bad debt. Sometimes the customer delays the payment. He says, first you construct this bridge, then we will take 60% payment after 3 months. He wants to have quality assurance. If either of these 3 conditions are present, if either of the 3 conditions are present, there is no significant financing component. There is no significant financing component. Okay. But if the answer is no to all the above points, if the answer is no to all the above points, that means the variation is not because of these 3 reasons, then the next thing I need to do is to check the gap between the transfer of goods and service and the transfer of payment. When is goods and service transferred? When is the payment transferred? Now to keep the standard simple, they have said, if the gap is not more than 12 months or financing component is not considered significant, then the contract does not have significant financing component and no adjustment is required. If the gap is less than 12 months, suppose only 3 months credit is given, 6 months credit is given, 9 months credit is given, then you can treat it as no significant financing component. Or if the amount of financing component is also not significant, if you pay now, you pay 100 rupees. If you pay after 1 year, you pay 100.10. So financing component is not significant, then you treat it as no significant financing component and no adjustment to the transfer price is required. Second is, if the gap is more than 12 months, and plus financing component is significant. Financing component is significant. Year 0, year 3. If you pay now, you pay 1 lakh. If you pay after 3 years, you pay 1,35,000. So gap is 3 year and 35,000 is a significant financing component. Then check the rate of interest given in the contract. Check the rate of interest given in the contract. If it is not given, then calculate IRR. So this is important for exam purpose. They have asked question on this. Check the rate of interest in the contract or calculate IRR. If the rate is approximate to market rate in similar financing component, that means in the market, if you borrow money for similar type of situation, then if this rate is equal to this, you can use that rate for adjustment. But if the rate given in the contract is not approximate to the market rate, use incremental borrowing rate on payment to adjust the significant financing component. So this is what you will do for significant financing component. If the answer is yes to any of the above 3 points, but if you find that variation is due to any of the above 3 points, contract does not have significant financing component. So if the contract has significant financing component, what you will do? Either the contract liability will be adjusted with financing cost, or trade receivable will be adjusted with financing income, depending upon whether the customer is delaying the payment or customer is making payment in advance. Accordingly, will create a liability or a receivable. Now another highly tested question in the exam is variable consideration. That is, the consideration is not a fixed amount. It can vary due to factors like discount, rebate, refund, credit, concession, incentive, performance bonuses, etc. Okay. Variable consideration may be estimated either using. So please note down that this variable consideration part is very important. There are two ways to record the variable consideration. One is called expected value method, EVM. Expected value method will be used when there are large number of possibilities. When the number of possibilities are high, use expected value method. Here the formula is expected consideration into probability for each range or estimate should be given. So they may give you sale can be between 1 to 500. The price will be 30 rupees. Probability is 0.3. Sale can be 501 to 1000. Price will be 29. Probability 0.4. Sale can be 1000 and above, something like this. Price 28. Probability 0.3. Then you will multiply. Take the total. This is called expected value method. This is called expected value method. And the second one is called most likely outcome method. So this we will call EVM. This will call MLO. When small set of probabilities exist. A small set of probabilities exist. So then we'll consider most likely outcome as estimated consideration. So the one with the highest probability given, the one with the highest probability given will be taken. The one with the highest probability given will be taken. Now, when you are having variable consideration, we'll have to apply one test called constraining or limiting the estimate of variable consideration. Variable consideration is only recognized if it is highly probable that a subsequent change in the estimate would not result in a significant revenue reversal. Very important. Variable consideration will be recognized only when you are damn sure that you will not have to reverse the revenue. Like for example, in case of construction contract, the question in the exam and in your study material, that if you complete the work on time, you will get 5,000 rupees extra amount. Now this 5,000 is a variable consideration that will be received by the entity only if the work is completed on time and as per the specification, as per the quality. But you will consider that in revenue only when you are sure that a significant reversal will not take place. So next point is accounting for non-cash consideration. So very easy. So one party says, I will give you laptop The other party says, I will give you scooter. So the question is, this laptop dealer who is selling the laptop and receiving the scooter, how he is going to recognize the revenue? This comes in many other standard also. It will be accounted at fair value. If not reliably determinable, it is measured indirectly by reference to stand-alone selling price of the goods and service. So this is how non-cash consideration will be recorded at fair value. Now we'll come to step number 4. Allocate the transaction price to each performance obligation. This is also important for exam purpose. Questions up to 16 marks have been asked on this area, allocation of transaction price. The issue will arise only if there are more than one performance obligation. If the entity has a single performance obligation, if there is only one obligation, then the question of allocation does not arise. However, if there are multiple performance obligations, then allocation is required. Simple. If I am going to sell you this mobile phone and this pen also, both together, I said you buy mobile phone and this pen for 40,000 rupees, then I will have to allocate the consideration in the ratio of relative standalone prices of goods and service. So you will pay me 40,000, but I will have to allocate it in the ratio of standalone price of the mobile phone and the pen. These standalone prices are considered on the date of inception. How to identify standalone price? Sometimes it can be very easy, but sometimes it can be difficult also. Standalone prices are observable market price of goods and service. That is the price at which these goods and services are sold or transacted in the market on its own, which is my first preference. The first preference will be the observable market price, but if such observable market price is not available, then apply the market assessment approach. Apply MAA, M-A-A, MAA. Apply MAA, market assessment approach, that is consider what a customer will be willing to pay for it. What the customer will be willing to pay for it, it's called market assessment approach, which is highly subjective, of course. If market assessment approach is also not feasible, then the next alternative is cost plus margin approach. So first we will give preference to observable market price. If that is not available, market assessment approach. If that is not available, cost plus margin approach. And if that is also not applicable, then we have another method called residual approach. If A plus B plus C are sold for 150 and A is sold for 100, B is sold for 30, so total 130. So what we can do, we can allocate C 20 rupees, that is called residual approach. But here there is a small condition which can be applied only if standalone price cannot be identified for a single performance obligation. Balance performance obligation have observable standalone price. So if A, B, C together are sold for 150, we should have observable standalone price for A and B, then only we can apply residual method. And the next thing, such residual value should fall within a range of selling of such goods. 20 rupees should be in the range of selling such goods. Suppose C is sold somewhere in the range of 15 to 40 rupees. This 20 comes between 15 and 40, then I can take 20 rupees as residual price for C. Now your question is, if residual approach cannot be applied, Suppose the range is 40 to 50. See, range is 40 to 50. Our balancing figure is 20. It is outside the range. Then residual approach cannot be applied, and it is left to apply market assessment or cost plus margin approach. Then in that case you have to apply market assessment or cost plus margin approach. If group of performance obligation can be identified, then standalone price should be based on group prices. These prices will later on be allocated in the ratio of standalone prices of individual goods. So A plus B is sold for 120. A plus B plus C is sold for 150, which means out of 150, A plus B is 120 and C is 30. Then this 120 will be further allocated between A and B in the ratio of their standalone prices. So this is called allocation of transaction price to each performance obligation. Now the last step is recognize revenue as each performance obligation is satisfied. So depending upon what that performance obligation is, the revenue will be recognized. So a car dealer will sell car, 3-year warranty, 5 after sale service. So there are 3 performance obligation. You have to first allocate the transaction price over the 3 performance obligation. You will recognize revenue with respect to car when the control of the car is transferred to the customer. Every year you will recognize warranty expense over 3-year, warranty revenue over 3-year period, and 5 after sale service you have to provide. So as and when after sale services would be provided by you, you are going to recognize the after sales revenue part. This is called recognize revenue as each performance obligation is satisfied. The transaction price allocated to each performance obligation is recognized as and when performance obligation is satisfied. Now there are 2 approaches here. One is called over a period of time and second is called at a point in time. Over time means over a certain time period. Like I am teaching you FR and SFM, and suppose it is a 2-year course. So it will spread over 2 years. That is called overtime. Or for example, a contractor who has to construct a building for the client. So he is going to take 4 years to complete this building. So he accordingly will recognize revenue over time. At a point in time means immediately the revenue will be recognized. You will say, sir, I want to buy this summary chart book. I say, welcome. You pay the price, I deliver the book to you, and I will recognize the revenue. That is called at a point of time. Now, for exam purpose, when will you apply satisfied over time basis for revenue recognition? Satisfied over time will be applied when certain conditions are satisfied. Satisfaction occurs when control of the promised goods and services is transferred to the customer. So first you understand when should revenue be recognized? When control of the promised goods and services is transferred to the customer. When you are in intermediate, the condition was risk and reward. Now the terminology has changed. It is not risk and reward, it is the control of the promised goods and service transferred to the customer. So when is control transferred? When the customer has the ability to direct the use of the asset, when the customer will obtain substantially all the remaining benefit from the asset. So factors to be considered while assessing control. So whether control is transferred or not, entity has the present right to payment for the asset. So control is transferred when the entity has the present right for payment, entity has physically transferred the asset, entity's legal title of the asset. These are the factors to be considered, and the risk and reward of ownership. All these factors are considered to check whether control is transferred or not. Acceptance of the asset by the customer. These factors will help us to determine whether control is transferred. Now, revenue is recognized over time when any of the following conditions are satisfied. When any of the following conditions are satisfied, revenue will be recognized over time. And if all the conditions mentioned here are not satisfied, then use point in time basis. Then revenue will be recognized at the point of time. So what are the conditions? The student will have to remember this for answering question in the exam. Sometimes they give a case study on this, whether you will follow satisfaction over time basis or whether you will follow point in time basis. So first is customer simultaneously receives and consumes the benefit. Example, a teacher teaching FR, SFM, and suppose it's a 1 year or 2 year course. The customer, here it's student, receives and consumes the benefit as it is provided. So in that case, we can recognize revenue over time. Suppose our course started on 1st January 2024 and the course will go up to 31st March 2025. So what I'll do, from 1st April 24 to 31st March 24, 3 months revenue I will recognize in this financial year, and from 1/4/24 to 31st March 25, this 12 months revenue we can recognize proportionately in the next year. Suppose in your office your boss does accounting work for a client and he has to do account writing for 12 months. Then as and when the account writing work is getting done, the customer is able to enjoy the benefit. Second is, second condition, this was 1, this is 2, asset which is controlled by the customer is being improved or increased in value. So the customer has given you a land and you have to construct a building over it. So as and when you are doing construction work, the value of this asset is improved or increased in value. So in that case also we can apply satisfied over time basis. Example, A Limited has a plot of land, B Limited is doing construction on it. When B Limited does construction, asset is improved. Or third one, third condition, these are either or condition. Either or, if any of them are satisfied, you will follow satisfied over time basis. There is no alternative use to the entity and the right to seek, and the entity has a right to seek payment. That means whatever you have done, it is of no use to you. But yes, as per the contract, you have the right, you are entitled to seek payment for the work done. The entity has a legally enforceable right to obtain the revenue. Then in that case, you will recognize revenue as and when the work is performed. For example, in your office, you do statutory audit. Once you perform statutory audit, let us say you have done statutory audit 60%, and for some reason the client says no, you can't work further. Whatever you have done is of no use to you. but you are entitled for that 60% of the work done. If this is the case, then revenue will be recognized on satisfied over time basis. When will revenue be recognized at point in time basis? When none of the three criteria mentioned for satisfied over time basis are fulfilled, then we will follow point in time basis. So point in time basis means revenue is recognized when the entity transfers control of the asset to the customer. Now the next task is to understand some special business models. Like for example, consignment. Consignor sends goods to consignee. This type of question they ask for 4 to 8 marks in the exam. When should revenue be recognized? When consignor sends to consignee or consignee sells to a third party? That is the question. So we have to apply this test. If the goods cannot be returned or transferred by the entity to the others and has obtained payment right, then we will call it as a sale. But if the other party can return the goods, can transfer the goods, and will make payment only after he has sold goods to other party, then it is a consignment arrangement and revenue will not be recognized until the consignee sells the goods. Another issue is when should principal and agent should recognize revenue, and how to identify whether the other party is your principal or agent. So, and if the entity has inventory risk, I have sold goods to another party, but then I carry the inventory risk. If he is not able to sell, I will have to take those inventory back. If the inventory become obsolete, that is my risk. If the other party is not able to collect the amount from the customer, I will have to bear the bad debt risk, that is credit risk, and I have to satisfy the performance obligation. Then we are principal. If we are carrying inventory risk, we are carrying credit risk, we are responsible for performing the obligation, then we are the principal. Otherwise, the entity will be treated as agent. So what is the accounting treatment? If the entity is the principal, gross amount will be recognized. Entity is the principal, recognize the gross amount. Suppose you are a person who is a train ticket agent. Your job is just to book a ticket on behalf of customer. Then you are not a principal because you are not responsible for providing the performance obligation. But if you are an agent, suppose the ticket is 2000, your commission is 400 rupees, and if it is an agent, then the revenue recognized will be net amount, means 400 rupees the entity is entitled to retain in return for services as an agent. So this is something important because nowadays there are many websites who are acting as an agent, but in order to improve their top line, they are showing the gross amount as a revenue. So when you will be doing audit of such companies, Make My Trip, Go Ibibo, okay, and Clear Trip, and so many, Yatra, etc., etc., etc. One has to check whether they are acting as a principal or acting as an agent. Some time back, they had asked a question on the model of MMT, Make My Trip. Under that, they provide tickets to the customer, but they are free to decide the price. They take the risk of not being able to sell. They take the credit risk. So in that case, their position will be that of the principal. Now next is repurchase right. A sold goods to B. Then the contract is designed in such a manner that these goods will be repurchased by entity A. The contracts are designed in such a manner that these goods are going to be repurchased by entity A. How to do accounting? So first of all, if there is a repurchase right, but there is no probability of repurchase, there is no probability of repurchase. It's only for theory that there is a repurchase right, but you know that this repurchase is not going to happen. A sells goods to B for 100 rupees, and after 3 months A has a right to repurchase it for 2000 rupees. A has a right to repurchase it for 2000 rupees, which means most probably or 100% probability is that this will not be repurchased. So it means ignore such right. It is not going to get converted into actual possibility. But if there is a probability of repurchase, if there is a probability of repurchase, A sold to B for 150 and A will repurchase from B for 100 rupees, and there is a probability that it will be repurchased. So what the standard says, the difference 50 is nothing but it is a form of lease rental. Amazing. So what B is doing basically, B is paying you 50 rupees for using that asset. A sold to B, B gave 150 rupees. A will give 100 rupees and take the asset back. So B is actually paying 50 rupees for using the asset. Treat it as a lease under Ind AS 116. And one more question which they ask in the exam, it is equal or higher than selling price, sold for 100 and will be repurchased for 105. So basically you are paying 5 rupees interest. So this 5 rupee will be treated as this entire arrangement will not be treated as a revenue under this standard. Rather, it will be treated as a financing arrangement under Ind AS 109. You will study in Ind AS 109 also that this will be treated as a financing arrangement. Okay. Next is bill and hold arrangement. Bill and hold. So you go to a shop, A goes to a shop and he says, I want this iPhone. iPhone is available. It is on the counter. He takes out, prepares a bill. You accept the bill. But then the customer A tells the shopkeeper that you hold it on my behalf. I will come and collect after 3 days. This is called bill and hold arrangement. Whether the shopkeeper will recognize the revenue now or after 3 days, that is the question. And this is again a theory question for 4 to 5 marks in the exam. So the answer is revenue can be recognized today if certain conditions are fulfilled. Following criteria need to be met in order to treat the contract as bill and sale. First point is the reason for bill and hold arrangement must be substantive, which means customer has requested the arrangement. The request should come from the customer. The customer should tell the shopkeeper that please hold this asset for some time. Sometime A has purchased some interior designing product from the shop, but his office is not yet ready where he can install it. So normally he asks the shopkeeper that this interior decorating item you please keep with you. Once my office is ready, I'll take it from you. So then it is substantive. Customer has requested the payment. Second condition is the product must be identified separately as belonging to the customer. So I gave you an example of an iPhone. So the shopkeeper must identify that particular iPhone and keep it separately. He should put a stamp on that this item is sold to this customer, belonging to a customer. And third is, the product currently must be ready for physical delivery to the customer. If the customer wants, he can take the physical delivery. Customer says, I want iPhone 16. Take this advance 1,50,000. You said that iPhone 16 is not there. So customer says, don't worry, whenever it will come, you deliver it to me. Then in that case, it is not a bill and hold arrangement. Revenue will not be recognized now because the item is not ready for physical delivery. And the next condition is, entity cannot have the ability to use the product. So once the product is sold, entity cannot use it for its own purpose, or entity cannot direct it to another customer also. So the product which has been sold cannot be used by the entity itself, cannot be sold to another customer. If these conditions are satisfied, here all conditions are required to be satisfied. If all conditions are recognized, are satisfied, then the revenue will be recognized. Sales revenue is not recognized when there is simply an intention to acquire or manufacture the goods in time for delivery. So you place an order with a supplier. Supplier says, I am going to manufacture in 3 months and then I will deliver it to you. Revenue is not recognized in such cases. Revenue is not recognized in such cases when the item is not ready, but it will be rather acquired or manufactured in future time period. So the amount that is received from the customer is treated as advance. Holding of goods is treated as a separate performance obligation. If you hold the goods on behalf of customer says you keep this goods with you, I will come after 3 months and collect. Then you will say, see boss, I will hold it on your behalf, but then I am going to charge you some rent for this because I have sold it to you. You should take the delivery. Customer says, okay, I will take delivery after 3 months and you can charge me. That is treated as a separate performance obligation and which is satisfied over time basis. So that will be recognized as satisfied over time basis. So thank you very much. This was a very quick, super fast revision of our chapter Ind AS 115. So you can revise the entire Ind AS by purchasing this book from our website called Summary Chart. And there is one more very good book that is called Financial Reporting Compact. Financial Reporting Compact, which contains the entire syllabus in simple language so that you can revise it one day before the exam. Is it right? Can you see that? And then there is a very good book I have prepared called Compiler. Compiler. What is compiler? It contains questions from RTP, MTP, exam and study material plus some other good books also. So the student can purchase this compiler. This book is very useful for CA final, CMA final student. Okay. So dear student, thank you very much. Please subscribe to YouTube channel AS Foundation, and we are going to start this series of super fast revision of important Ind AS. So next super fast revision is coming soon. It will be announced on our YouTube channel and social media. Please keep watching our YouTube channel and also subscribe, join, ask your friends also, share in all your WhatsApp group, all your friends group, all your Telegram group that this is a very useful YouTube channel and The student will get lot of benefit from this. I have uploaded the lectures on FR, SFM. In fact, all the SFM, RTP, MTP of this year with solution I have uploaded on the YouTube channel. You'll get benefit from that. So thank you very much. See you next time very soon. Hello, good evening everybody. Let us come to the quick revision of super fast revision of financial reporting topic Ind AS 103. What is Ind AS 103? It is business combination. This is one of the very important standards for your examination, and all of you must do it thoroughly, because you can expect a question of around 15 to 20 marks on this topic, and usually they ask a question on this. So we are going to discuss all the important principles of Ind AS 103. So this is a super fast quick revision. I am going to give you complete guideline on how to solve different types of questions. So kindly pay attention. If you want to get the maximum benefit of this lecture, then you can purchase from our website on which this presentation is designed. This book is called Financial Reporting Compact Book. It covers the entire syllabus in simple words, in very easy to understand format. Anybody can understand it. Institute module has a lot of complicated paragraph statements. They don't give you things very nicely, properly. So in this book, what we have done, we have presented the chapter, you can see, in a very simple manner. So you can revise it one day before the exam. The whole syllabus you can revise in just few hours. So I would highly recommend that you purchase this book FR Compact from our website vino.in. This contains theory, only theory, and step-by-step presentation and solution that you need to follow, but this does not contain question answer. If you want question answer also, we have this another book called FR Compiler. You can purchase FR Compiler from our website vino.in. It contains question from study material, RTP, MTP, past exams. So this will be very useful. This combination of compact and compiler will be very useful for your FR preparation, for whether you are a CA final student or CMA final student. So first we will start with the introduction of business combination. This is a very wide standard. It covers many aspects of business combination. It covers mergers and acquisition. It also covers accounting for consolidation on the date of acquisition. What about subsequent accounting? The subsequent accounting will be taken care of by Ind AS 110. But on the date of acquisition, the accounting of consolidation is done as per Ind AS 103. Then it deals with accounting of business, which may not be a subsidiary. You may just acquire a business, and it is also covered by this standard. This accounting standard also deal with common control transaction, including demerger, highly tested in your exam, and all this we are going to discuss in our today's lecture. This is our agenda. What about asset acquisition? If it is not business combination, if it is just asset acquisition, it is not covered by the standard, but this standard gives you some guidance on accounting of asset acquisition. Common control transaction is not covered by IFRS 3. International standard IFRS 3 does not have common control transaction. So accounting of common control transaction covered by Ind AS 103 is a carve-in, is a major difference between our standard and IFRS. So one carve-in you will learn in Ind AS 103. Now we'll come to first thing first, meaning of business combination. Hello to everybody who has joined our live session just now. So meaning of business combination, what is business combination? Meaning of business combination is a business combination where acquirer obtains control over one or more businesses. Acquirer obtains control over one or more businesses. Who is an acquirer? One who acquires control over the other business. What is the meaning of control? This is covered in Ind AS 110. Your definition of control is covered by Ind AS 110, and the meaning of business is covered by this standard. Control is covered by 110. Acquirer means the entity which obtains control. And what is business? The definition of business has undergone change by an amendment in Ind AS 103 on 24th July 2020. Now the meaning of business is, it is a set of activities. It is a set of activities which qualify business assessment test. It is a set of activities which qualifies business assessment test. So we will call it BAT, business assessment test. Hello to everybody who are joining the live session. Hello Rahul, hello Amol. Now next is, what is the meaning of business? So let us quickly just go through some theory part as an introduction, and then we'll see what kind of question they will ask you in the exam. So are you ready? If you say yes, then I will go further. Say yes. Business means an integrated set of activities and asset. Today is a super fast revision batch, so we'll not have time to discuss each and every line item, but still I will try my best that in the given time slot we can complete the entire chapter. So it is an integrated set of activities. The set of activities and asset which work together, the set of activities which works together, capable of being conducted and managed for the purpose of producing goods and services. So this is what we generally know as business, set of activities which help us in producing goods and service. But this standard of business also includes or for investment purpose or investment income. Not just producing goods and service, set of activities can be used for earning investment income like dividend and interest. So there can be a company which may only be providing investment service, portfolio service, or from other income from ordinary activities. So this is the meaning of business, integrated set of activities for producing goods and service, earning income, or any other income from ordinary set of activities. Now let us see what are the elements of a business. So business has three elements. Business has three elements: input, process, output. But please remember, output is not a necessary condition. So first we will see what is the meaning of input. What is the meaning of input? Input are economic resources which have ability to create output by applying one or more processes. So if there are raw material which can be processed and converted into finished goods, that is input. In a coaching organization, we are the inputs. Okay. Then inputs will include assets and workforce. Which kind of assets and workforce? Skilled and special workforce are included. Not all workforce need to be skilled. Assets will include PPE, intangible assets. Other assets and liabilities are not inputs. Input will include your workforce and certain assets like PPE, intangible asset, but other assets and liabilities are not inputs. What is process? any system, standard, protocol, convention or rule that when applied to an input or inputs creates or has the ability to create output. So processes are applied over input to create output, like production process, okay, manufacturing process, whatever. They depend on type of business, the process can vary accordingly. The processes typically are documented, that is, the organization will make a list of the steps that is followed, but an organized workforce having necessary skill and experience following rules and convention may provide the necessary process that are capable of being applied to input to create output. So it is not always necessarily documented. A set of skilled workforce, when they apply certain rules and convention on the input, it is capable of creating output. Now please note down what is not process. Accounting, billing, payroll and other administrative system are not processes used to create output. But of course, if your business is to provide accounting service, business is to provide payroll services, then they will become processes. And what is the meaning of output? So output means the result of input and process applied to those inputs that provide or have the ability to provide a return in the form of dividend, lower cost or other economic benefit to the investor or other owners, that is called output. Now please double underline or note down, remember, output is not a necessary condition for qualifying as a business. So for example, a research division can qualify as a business even though it may not be producing output right now, but it has the capability of producing output in future. How to identify a set of activities acquired by acquirer is a business combination. How to identify whether the set of activities acquired is a business combination, because if only it is a business combination, then the standard is applicable, but if it is an asset acquisition, then the standard is not applicable. So here what we'll do, now this is an amendment in 2020 in the definition of business and how to identify whether a set of activity is a business or not. So they have said, you first step 1 apply optional concentration test. Optional concentration, optional means this is not mandatory, you can apply it. If this test is satisfied, then it is an asset acquisition. We will discuss it in the next slide. First apply optional concentration test, whether majority of your payment that you are making consideration is for one or a group of asset only. If that condition is satisfied, we will call it asset acquisition. If that condition is not satisfied, then you go to step number 2. What is step number 2? Apply business assessment test. We will discuss again because that is very important for identifying whether a set of activity is a business or not. If the entity has not applied optional concentration test, as I said, this first step is optional. If you don't apply optional concentration test, then directly start with business assessment test. So what we will do in business assessment test, under business assessment test you have to check minimum one input. Those who have our compact book will mark it minimum one input plus you have substantive process that have the ability to create or produce output. If set of activities does not produce any output, as I said, output is not necessary, but it should have the ability to produce output. If the set of activities does not produce any output, it is possible the set of activity right now is not producing output, then check process is critical to ability to create output. So sometimes you acquire the research division. That process may be so critical that it is required to create output. Plus, you must also acquire organized special workforce. The process must be critical to create output, plus the people who are managing that. Just visualize a research department where scientists are sitting. They must also be acquired along with resources needed by such workforce. If this is satisfied, then we will say this integrated set of activities is a business. If set of activities produce output, first was does not produce output. If set of activities produce output, then what we have to do? Then we have to check process is critical to ability to continue producing output, plus organized special skilled workforce is acquired along with the resources needed. This is the same as the previous one, or the process is unique. Process cannot be created unless substantial time and cost is involved. So that process is either unique or it will require substantial time and cost. So if you want to create a similar business, it will take a lot of time. If you want to create another Reliance kind of business, it will take huge amount of time, huge amount of expenses. If these conditions are satisfied, if it is not producing output or if it is producing output, then this set of activity will be called as a business. Otherwise, it is an asset acquisition. Now the next question is, what is concentration test? Concentration test means, are we paying the purchase consideration only for the set of assets or not? If you are paying only for a set of assets, then it is asset acquisition. So let us see how to apply concentration test. Important for exam because it was an amendment in year 2020. So if you are reading from old book, old coaching, then you will not find it. So first you calculate the fair value of the interest acquired. Fair value of the interest acquired, plus you also add, first we will calculate fair value of interest acquired, which is equal to non-controlling interest. NCI means non-controlling interest plus consideration transferred in set of activities acquired. So this is what you have paid and this is the value of NCI. So if you have acquired 80%, this is 20%. So total is you are actually paying 100%. What you paid plus what is the value of the non-controlling interest in that business. Then you calculate the fair value of the asset acquired. Fair value of the asset acquired is equal to fair value of the consideration plus add fair value of the liabilities minus the cash and cash equivalent acquired. If any cash and cash equivalent is there which you acquired, you please deduct it. So this is the fair value of the asset acquired, what you paid plus also the liabilities that you assumed minus any cash. Now just note down that do not include deferred tax liability in the above liabilities. In the liabilities, deferred tax liability will not be considered because that is only a book entry. That is not a liability actually payable to the government. Then identify single identifiable asset. So if in the balance sheet you have PPE which is 900 and other assets 100. So this is a single identifiable asset or similar group of asset. This is 900. Fair value of the singly identified asset and fair value of the asset acquired as per previous step. Let us say 1000. So this comes to 90%. So 90% of your consideration is just towards one single asset. then we'll say concentration test is qualified. If 90% or more of the consideration is for single asset or similar group of identifiable asset, then it is a concentration test satisfied and you will follow asset acquisition. Then will follow asset acquisition. Now I'll tell you again, this standard does not deal with asset acquisition, but some brief guideline is given as to how are you going to do accounting in case of asset acquisition. So only one or two paragraphs we will discuss on asset acquisition. So those who have joined late, please refer our FR compact book for better understanding. Everything is written in this book in the same way, line by line, very useful for understanding of your CA final or CMA final FR. 1 hour you can revise the entire business combination chapter. And for numerical question, you can practice from our compiler, FR compiler. You can get it on our website vino.in. So let us come back to accounting for asset acquisition. Some guidance is given in Ind AS 103. So we'll pass the following journal entry. They can ask you a question on asset acquisition also. So what you do, you will pass the following journal entry. Revalue asset. Those assets which are taken over by the acquirer, you revalue asset transferred as a part of purchase consideration through P&L account. One student is asking a question, why P&L account? Why not revaluation reserve? The answer is, you are selling that asset in a business combination, so therefore those assets which you are going to sell and acquire a business, so indirectly you have realized those profit, and therefore the entry will be asset account debit to profit and loss account. In case there is a loss, P&L account debit to asset account. You have transferred certain assets and you have acquired another company's business, but it is not a business combination, rather it is an asset acquisition. So this asset which we are transferring, those will be revalued and the profit will be transferred to profit and loss account. Then you will record the assets and liabilities acquired. Assets account debit 1, 2, 3, 4 to liabilities account, whatever number of liabilities you have acquired, to consideration paid in the form of cash, to consideration paid in the form of assets, to consideration transferred in the form of share capital, and to bank any acquisition cost, and this way assets and liabilities acquired in an asset acquisition will be recorded. So some important notes I will give you. Keep in mind, very useful for solving question on asset acquisition. The question the student can ask is, suppose one lump sum amount is paid and you acquired many assets and liabilities. You paid 10 crore rupees and you got assets and liabilities. How do I allocate this 10 crore rupees? So the answer is, allocate consideration plus acquisition cost. Because it is an asset acquisition, the acquisition cost will be capitalized over the assets and liabilities acquired in the ratio of fair values. In case if you find that some assets are impaired, because of this you will apply Ind AS 36 impairment and bring it down to their recoverable amount. Do not record any goodwill. Why? Sir, in my 12th standard they taught us to write difference in goodwill. 12th standard is over. This is asset acquisition, not business combination. So do not record any goodwill. do not record any deferred tax asset or liability due to change in fair value. Cost of acquisition. Some questions are coming. Why cost of acquisition is capitalized? Cost of acquisition is capitalized because it relates to PP acquisition under Ind AS 16. Remember, what I am telling you right now is the accounting of asset acquisition, not business combination. So this was about asset acquisition. Our remaining discussion is on business combination. The method of accounting that is used for business combination as per Ind AS 103 is called acquisition method of accounting. Okay, so usually I will first tell you the basic entries that we pass in case of acquisition accounting. Following entries will be passed in the books of acquirer. This standard deals with accounting in the books of acquirer. So on the date of acquisition, we will write business combination account debit, agreed consideration. The amount is equal to agreed consideration to the acquirer or vendor. Actually, it should be acquiree, to the acquiree or vendor, being business acquired. First entry, business combination account debit to vendor account. Second entry, you will record the assets and liabilities taken over at fair value. Sundry assets account debit at fair value, to sundry liabilities at fair value, and to business combination account as per the previous line. If there is a difference on the debit side, goodwill will be debited. If there is a difference on the credit side, gain on bargain purchase account, which is what we call capital reserve. Capital reserve. Gain on bargain purchase or capital reserve account credit as a balancing figure. Now what about the presentation of gain on bargain purchase? If in the above entry we get gain on bargain purchase, then review the fair value and process of calculation including non-controlling interest. Is it right? Generally in business combination you will get goodwill because somebody is valuing business, so therefore usually they will pay a higher amount, but it is quite possible due to some reason the person who is selling his business may sell it at a lower price. So in that case the standard says you again check whether all the process that was used to calculate the fair value, the non-controlling interest are correct or not. If after your review you find that the condition of gain on bargain purchase still exists, then it should be first transferred to OCI. And from OCI it will be transferred to capital reserve. But sometime we are not able to satisfy this condition, that after review also we are not sure that it is still capital reserve. Then the answer is directly you transfer to capital reserve in SOCIE. If you think all processes have been correctly applied, then you transfer it to OCI first. Otherwise you transfer it directly to capital reserve in statement of changes in equity. Now if business combination is of entity, suppose you acquired another company, then such acquisition is less than 100% of ownership, which is usually asked in your exam, that a company acquired 80% share in other company. What about the remaining 20%? The remaining 20% will be treated as non-controlling interest. Non-controlling interest will also be recorded on the date of acquisition. More about NCI in Ind AS 110. Coming soon. Then come to the payment of consideration. The consideration payment entry will be vendor account debit to share capital, to deferred consideration, and to contingent consideration. This again we'll discuss subsequently. Some consideration may be paid at a future date. That is called deferred consideration. Some consideration may be paid subject to fulfillment of some condition in future. That is contingent consideration. Now, one thing which your study material of institute does not write properly, but we have made a very good summary on that. I hope you will like it. What are the types of business combination for accounting purpose in the exam? This is something really useful for you. See the question and you find out whether it falls into which of the type of business combination we are discussing. Accordingly pass the entry. Is it right? I request all the students to subscribe to YouTube channel. Please subscribe immediately. Click on the subscribe button of our channel AS Foundation. And also please click the like button. This will motivate our team to work hard for the benefit of the student. Okay. And also share with your other CA or CMA final student, because many students, they are not aware that we are conducting this super fast quick revision batch. So requesting all of you to kindly like, share and subscribe to our YouTube channel. I'll be very happy. So let us come to accounting in the books of acquirer. Accounting in the books of acquirer. Now what are the types of question they will ask you? Pay attention on this case number. So I will take 4 slides for 4 cases. First, case 1. B Limited acquires 100% of shares in A and A Limited becomes subsidiary of B. So it is a case of 100% acquisition of share in another company. Then you will find there are 2 entries, one on the left side, one on the right side. In the left side, the entry in the separate financial statement, and on the right side, the entry is in the consolidated financial statement on the date of acquisition. So in separate financial statement, if you acquire shares in a subsidiary, then you just pass the entry investment account debit to bank account. But in consolidated financial statement, what we'll do, we'll pass the entry identifiable net asset acquired at fair value, means assets account debit, liabilities account credit, goodwill will be balancing figure. Any goodwill appearing in the books of acquiry, you don't write it. Let the goodwill be the balancing figure here. Then to investment. Suppose you have acquired less than 100%. Suppose you have acquired less than 100%, then you will credit non-controlling interest also. If you have acquired 100% interest, then there is no need to write non-controlling interest. If you have acquired less than 100%, then you have to write NCI. What about the accounting entry for post-acquisition changes? Further accounting in consolidated financial statement will be covered by Ind AS 110. Now please focus here. Case 2. B Limited acquires 100% of A. A Limited closes down. That is, it is merged with the entity B. In the first case, B continued as a subsidiary. In second case, A Limited is merged with B. A Limited absorbs B. What we used to call in intermediate absorption. B Limited continue to exist. So only the acquirer will exist. Acquiry will be closed down. Acquiry will be closed down. Like for example, SDFC Bank will acquire SDFC Financial Institution. Only this will continue. this will close down. HDFC financial institution will close down. In that case, this set of entries will be passed. So first I'll come to SFS, separate financial statement, business combination account debit to vendor account, identifiable net asset account debit, goodwill account debit balancing figure to business combination account, and then vendor account debit to bank account, vendor account debit to bank account, depending on what kind of the mode of payment you write. So to bank or to cash, to asset, whatever. And in case of separate financial consolidated financial statement, pay attention. Now because the subsidiary is not there, there is no question of consolidation. Whatever figures we have written in SFS, the same figures will continue in CFS also. There is no entry for post acquisition change. NCI will not be there. This was my case number 2. Now we'll come to case number 3. This is also important. Suppose a company A has 3 divisions, B1, B2, B3. Okay, B1, B2, B3. Then another company B Limited acquires division B2. Only a division is acquired. The whole company is not acquired, but a division is acquired, and that division B2 meets the definition of a business. So in that case, the entry in SFS will be same: business combination to vendor, identifiable net asset, goodwill account debit balancing figure to business combination, and make the payment with vendor account debit to bank. In consolidated financial statement, there is no extra effort required because we have not acquired a subsidiary. Same figures will be used in CFS also. No need to pass post acquisition change entries because there is no subsidiary. No question of NCI. Now case 4 is on demerger, highly tested in the exam. Double tick mark, highly tested in the exam. Now there is a company A, 3 divisions, B1, B2, B3. Now they will say B2 is demerged. B2 is demerged and a new company will be formed, to which the assets and liabilities of division B2 will be transferred. This situation is called demerger. A Limited is called demerged company. New company B is called resultant company. What about the accounting? Accounting of demerger we will discuss towards the end. So kindly watch this video till the end. You will be benefited. Now we'll come to contingent consideration. Under Ind AS 103, the consideration paid will also include contingent consideration. Contingent consideration means payable to the shareholder depending on certain future condition, depending on satisfaction of certain outcomes in future, then it is payable. That is why the term used is contingent. It is dependent on some future event. Contingent consideration is payable to the shareholder without condition to remain in employment, and it can be in the form of cash or it can be in the form of equity. Consideration can be paid only in the form of cash, and consideration can be paid in the form of shares. Now the question is, what about number of share? Number of share can be fixed or number of share can be variable. So if number of share is variable, you have studied in a standard on financial instrument Ind AS 32 that it is a liability. So therefore, if the contingent consideration is payable in cash or payable in number of share which is variable, it will be treated as a liability. Okay, how it will be measured? Initially measured at fair value. On the date of acquisition, fair value. What about subsequent change? Fair value. Change in fair value will go to P&L account. Settlement will be made as specified, either in cash or in the form of number of shares. Other possibility is that contingent consideration can be paid only in the form of equity share in fixed number. So you have seen in Ind AS 32, if equity shares are issued in fixed number, then we call it as equity. Initially recorded at fair value. But subsequently, if contingent consideration is payable in the form of fixed number of equity share, very important, it will not be remeasured. You can get a 4 mark or a 6 mark question from this paragraph, and accordingly you have to do the accounting. Upon settlement, any difference, if any, will be adjusted directly in the statement of changes in equity. Now I am going to tell you something very important, how to calculate purchase consideration for business combination or agreed consideration. What are the items you will add and deduct? So I request you to kindly pay attention to this very important table, not given in your ICI study material, but very useful. All your basic calculation of purchase consideration will fit into this format. So first what you will do, you will add fair value of any asset transferred. It can be cash, it can be any other asset like land. If any share is issued, we'll take fair value of the share issued. If there is any deferred consideration, we will take present value of deferred consideration. So this you will add. If there is any contingent consideration, that also will be taken at fair value. Now, confusion. Deferred consideration will be at present value. Contingent consideration will be at fair value. Contingent consideration will be present either in non-current or current liabilities depending on when it is payable. Then we will take fair value of contingent consideration payable in equity shares. So it can be payable in cash, then point D, payable in fixed number of equity share, point number E. Then there can be value of share based payment award also. The acquirer company may agree to issue shares to the employees of the acquiring company. So this I am going to discuss after some minutes, how to do the calculation of this, highly tested in your exam. So then we'll take a total of point number A, B, C, D, E, F, that is consideration. So usually you will get adjustments up to this only, but there can be some additional adjustment for separate transaction cost, STC, separate transaction cost. Now what is STC? It means there can be some outstanding receivable or payable between acquirer and acquiree. Acquirer may be a debtor, acquiree may be a creditor, or acquirer may be a creditor, acquiree may be a debtor. So all those pre-existing relationship will also be closed. So in that case we are going to make adjustment. So if any asset is written off, we will add, and if any liability is cancelled, we will deduct. This will give me purchase consideration for business combination, PC for BC, PC for BC or agreed consideration. Now a small discussion on reacquired rights. Reacquired rights. A has given rights to B, like license, brand. Now B is acquired by A, so these rights are also acquired by A. What is the treatment of reacquired rights? These are the rights which the acquirer before acquisition may have granted to the acquiree to use certain asset which belongs to the acquirer, like a trademark, for example license, brand, franchisee rights. So now this pre-existing relationship will be cancelled, and any settlement gain or loss will be treated as a separate transaction, because it is settlement of a pre-existing right. It will be treated as a separate transaction and will be recorded in the financial statement of the acquirer. So contingent consideration, I want to discuss something more, because institute has given lot of situation here. So first is, a contingent consideration can be payable to a shareholder who is also an employee. And condition of contingency is to remain in employment. Condition is that he will remain in the employment apart from other condition. So now what our standard says, this is outside the scope of 103. If the condition is that a shareholder who is also an employee will remain in employment, is outside the scope of the standard, it will not be a contingent consideration as per Ind AS 103. It will be dealt by other standard. For example, it will be dealt by either Ind AS 19 if it is a non-share based award, or it will be dealt by Ind AS 102 if the consideration payable is in share to employees who are also the shareholder. Case 2, contingent consideration is payable to employee who is not a shareholder, and the condition is to remain in employment apart from other condition. Now again the standard says, if the condition is to remain in employment, even if you are not a shareholder, it will be covered by either Ind AS 19 or Ind AS 102. So in both cases, if the condition is to remain in employment for a certain number of years, any payment to be made will be covered by Ind AS 19 or Ind AS 102. Case 3, contingent consideration payable to the shareholder without condition to remain in employment. So if there is no condition of employment, it may be contingent on some other condition. It may be contingent on profit, market price target, market share target, EPS target. Then as we discussed earlier, if it is payable in cash or variable number of share, it is liability. Record at fair value, change in fair value P&L account, settlement will be made as specified. If payable in variable number of share, it is treated as equity, recorded at fair value, subsequently not remeasured upon settlement. Directly it will be adjusted in SOCI. So this I think we had covered earlier also. What about acquisition related cost? Lot of legal cost, administration cost, brokerage, investment bankers fees, printing and stationery, etc. are incurred. If it is a business combination, all acquisition related cost will be transferred to P&L account, except cost of issue of debt or equity. Except cost of equity or debt issue, now we have seen it will be covered by Ind AS 109, because in Ind AS 109 cost of issue of equity is not adjusted in P&L account, but it is adjusted in SOCIE. Now another highly tested area is treatment of share based award. Already issued by the acquiree. A has acquired B. B has given share based payment award to the employee, B is acquired by A. What will happen to those SBP which is promised by B to its employee? So if the acquirer, this company A may say, don't worry, we will give you our share. We will give you our share, or we will make some modification in the existing SBP only. So if issues new award which are in the nature of replacement award or which are amendment or modification to existing award, then we'll follow the following steps. Pay attention, highly tested in the exam. If the acquirer company issues share-based payment award which is held by the employee of the acquiree, how you will deal with? So first you calculate the value of award to be included in purchase consideration. How much of that SBP award will be forming part of purchase consideration? So the answer is, we will calculate the fair value of that award to be included as a part of PC equal to fair value of original award, that is the award which were given by acquiring company on the date of acquisition. Fair value of original award on the date of acquisition multiplied by expired period, that is how many years are already over, divided by original vesting period or revised vesting period, whichever is higher. So fair value of original award, suppose 200, period expired 2, original vesting period was 4, but the revised vesting period is 5, so I will divide by 5. But if original vesting period is 4, revised is 3, I will take 4. So this amount will be forming part of purchase consideration, which I had shown you in a table, share-based payment award. But if some more years of services are yet to be rendered, then there will be post-combination service cost. Post-combination service cost will be dealt as per Ind AS 102, and the calculation will be fair value of the amended award or replaced award on the date of acquisition. So here I will take fair value of the replaced award, new award on the date of acquisition, minus value considered in purchase consideration, previous step 1. If this formula gives you an answer 200 rupees for example, and this is suppose 400, 400 minus 200 already considered, remaining 200 will be treated as post service combination service cost, and it will be allocated over the remaining vesting period in the post combination period. So that was about SBP award. Now very important, recognition and classification principle for identifiable net asset. Are we going to recognize all the assets and all the liabilities that are appearing in the books of acquiree, or can we re-evaluate whether these assets and liabilities fulfill the recognition criteria or not? Second, are we supposed to follow same classification or we are supposed to follow a different classification? So the answer is, when you are recognizing assets and liabilities acquired, in case of acquisition accounting, we have to check whether they meet the definition of asset and liability on the date of acquisition. If they meet the definition of asset and liability on the date of acquisition, then we are going to record them at fair value. So first they should meet the definition of asset and liability recorded at fair value, but there are some exception. There are some exception on the recognition and measurement. So we have to keep in mind some recognition and measurement exception, very important for exam. Your institute will check your knowledge on every line item. So if you have acquired any asset in business combination but you want to sell it, so this is called asset held for sale. In that case, we will not record it at fair value, but we will record it at fair value less cost to sell. Fair value less cost to sell. If you have some employee benefit like gratuity provision, then that is recorded as per Ind AS 19. If you have any leased asset or lease liability, then they will be recorded as per the value given in Ind AS 116. One important query is on contingent liability. Since the students are highly talented, they are well aware contingent liability is not shown as a liability in the balance sheet, but contingent liability is disclosed. So there can be contingent liability in the books of acquiree. Can we record it as a liability in the balance sheet of acquirer? And secondly, can we record indemnification asset? This is indemnification asset, my mistake. Like there may be some liability in the contingent liability in the books of acquiree. There is a court case going on, and then that we are not able to decide whether we should acquire this company or not because of the ongoing court case. The acquiring company says, don't worry, if you incur any loss, we will indemnify you. We are going to compensate you. So then that is called indemnification asset. First question is whether contingent liability of acquiree will be recorded. So this is an exception. This is a very important exception. Contingent liability would be recorded if two conditions are satisfied. They can ask you in your interview also in future. First is there must be present obligation arising from past event. There must be present obligation arising from past event. And second condition is its fair value can be measured reliably. Then this contingent liability will also be shown as a liability in the books of acquirer. So condition is there must be a present obligation arising out of past event, and second is whose fair value can be measured reliably. Should we record indemnification asset also? So Mr. Rathi is saying that yes, we should record indemnification asset also. So indemnification asset will be recorded at fair value on the date of acquisition, but the amount recognized for indemnification asset will not exceed contingent liability recorded. So if contingent liability recorded is 50,000, the maximum amount of indemnification asset will be 50,000. So this also you mark as important. Now next is classification of asset and liability acquired. Classification. Can we change the classification? Can we change the classification? Is it necessary to follow the same classification? The answer is we can change. Usually the acquirer may follow the same classification, but the classification can change on the date of acquisition depending on facts and circumstances. So acquirer is free to change the classification. Example, there may be some asset which were used by the acquiree, but the acquirer wants to sell it. So in that case, those assets will be classified as held for sale. Second example, there may be some investment which may appear at FVTPL, but the acquirer may decide to treat it as FVT OCI. So one Mr. Mohammed said, no, we can't change the classification. You are not right. We can change the classification in the books of acquirer depending on facts and circumstances. Okay, you can change. Next exception, where acquirer cannot classify on its own. Now here you have to keep in mind, they have given two situations in which you cannot change the classification. Which are these two exceptions? The exception number one is where acquiree is a lessor and classification is made as finance lease and operating lease. So if the acquiree who is a lessor has classified a lease as finance lease, you will also classify the lease as finance lease. If the acquiree has classified a lease as operating lease, you will also follow the same classification. And second is not very important for our syllabus, insurance contract, Ind AS 104. What about intangible asset acquired in business combination? Again very important. Intangible asset can be recognized separately from goodwill if they are identifiable. Now this is one important practical issue also. Acquirer company may acquire another company which may have lot of brands, and this question they ask in the question also. They may have trademark, they may have a research division. Now this may not be appearing in the balance sheet of acquiree because self-generated brand, self-generated trademark, research expenses are not to be capitalized. Can it be capitalized in the books of acquirer? The answer is yes, if they are identifiable. Identifiable means separable. Identifiable means separable. Separable means they can be sold, rented and exchanged. But again there is a small exception. If suppose any right is in the nature of contractual or legal right, any right is contractual or legal right, a contractual or legal right may not be sold, rented or exchanged. Example, government license, then also it will be treated as separately identifiable. In other cases you have to apply the test of separability. One more question they can ask you in the exam is in-house research of acquiree. Nowadays many companies are acquired because they have got some research division, research facility. Another company may take years to do so much of research, right? So therefore they may acquire the research division also, which may fulfill the definition of business. Can we recognize it as a separate asset? The answer is yes. It can be recognized as a separate asset if it can be sold separately. If it is capable of being sold separately, then any in-house research division will be treated as a separate intangible asset. After you have acquired it, you incur two types of expenditure: research, development. Subsequent research expenditure will be charged to P&L account. But development cost, if you fulfill the condition given in Ind AS 38, then development cost will be capitalized. Recognition basis, future economic benefit should flow to the entity from such intangible and the cost can be measured reliably. So in that case we can account for in-house research expenditure acquired from acquiree. Now the next issue is on which we have got some question in study material and RTP, MTP also. Measurement period concept. Measurement period concept. Okay. So suppose date of acquisition. This concept many students don't know. Pay attention. Date of acquisition is suppose 1st January 2024. Year ending date is 31st March 24. 1 year of acquisition will get over on 31/12 say 25. 1 year is over. Now the standard says you have to take fair value on the date of acquisition. Theoretically looks easy, practically difficult because companies are huge. So you may not be able to get the fair value of all assets and all liabilities on the date of acquisition. So you can do provisional accounting here. You can take provisional figure here, and then the standard says if you are able to find out the fair value up to 31st March, which is the first year ending date, what will you do? Suppose you are not able to find out the fair value up to the first year ending date also, then you are given total 1 year time to find out the fair value and update your provisional figure. But if you are not able to find out the fair value even in 1 year time span, but you can find out the fair value after 1 year is over, what will be the accounting treatment? So these are the situation we are going to discuss on the date of acquisition, on the first year ending date, after completion of 12 months, on completion of 12 months, and then after that date. So first, case 1, information is fully available on the date of acquisition. Your life is simple. Most of your exam questions are on this basis only, that fair values are available on the date of acquisition. So we will apply fair value and do the accounting. But for a theoretical question, they can ask you that fair value is not available on the date of acquisition. Information is not available on the date of acquisition. We can't calculate fair value for every item on the date of acquisition. Then the standard says you can use provisional fair value and use it in the journal entry. So use provisional figure. After that, suppose by the balance sheet date, the information is obtained fully. So we have discussed the date, 1st January 24 date of acquisition, 31st March 24 information is fully available. So now you can update the figure of asset liability. When you update the figure of asset and liability, possibly goodwill or capital reserve may change, and also deferred tax adjustment may take place. Non-controlling interest figure can also change. So all the consequential effect you have to give. Suppose you are not able to completely obtain the fair value by the first balance sheet date, then what will you do? You will disclose in the notes to account that fair value is based on provisional figure. Then after, suppose that first year ending is over, the standard gives you a total 12 months time from the date of acquisition. If you are able to obtain the information about fair value even within 12 months from the date of acquisition, then you are allowed to revise the fair value to the correct value. Accordingly, goodwill or gain on bargain purchase will change. Accordingly, deferred tax may change, and any consequential effect like depreciation can also arise. And the disclosure will be required in the upcoming balance sheet about this change. But suppose you are not able to obtain full information within 12 months from the date of acquisition, then I have to freeze the provisional figure. Now I can't change the provisional figure as per Ind AS 103. Later on, after 12 months is over, you got the information, then Ind AS 103 is not applicable, but Ind AS 8, accounting for changes in accounting estimate, will become applicable. Under Ind AS 8, you can make the changes. Now you are not allowed to change the goodwill or gain on bargain purchase. The DTA, DTL which you had recognized earlier in business combination, that will not change. Now the standard says, on which you had a question also in the class, new information is obtained which was not existing on the date of acquisition. if an information is not existing on the date of acquisition and about that some information was obtained later on, then such information may change fair value, but it is not covered by 103, it is covered by Ind AS 8. So if information about a debtor that he will become insolvent is not available on the date of acquisition, after 10 months, suppose the debtor becomes insolvent, but that is not due to condition which existed on this date, it will not be treated as an adjustment under Ind AS 103. It will be treated as change in estimate. So we have to only adjust those information which existed on the date of acquisition. When you are solving problem of business combination, then the issue of deferred tax asset and deferred tax liability will also arise. DTA detail is covered by another standard which is Ind AS 12. First, very important, if any DTA or DTL is appearing in the books of acquiree, if any DTA or DTL is appearing in the books of acquiree, you will not consider those DTA or DTL. Then we will consider tax rate expected to apply on temporary differences. We will only consider that tax rate which is expected to apply. If the parent company A is in India, subsidiary is in USA, then we'll take the tax rate applicable to subsidiary, not the tax rate applicable to India, and we will compute temporary difference. As per Ind AS 12, temporary difference is the difference between carrying amount and tax base. Tax base of an asset is equal to future deduction and tax base of the liability is equal to carrying amount minus future deduction. This I am not discussing in detail today because that will require a separate standard in Ind AS 12. Tax base of non-taxable assets is equal to their carrying amount. All this will be explained to you under Ind AS 12. So this was about business combination accounting. Now we'll come to demerger accounting. Demerger problems are of two types. One is without common control and one is with common control. Common control means the person who was controlling before demerger continues to control after demerger. Continues to control after demerger. That is called common control. After this slide, we'll cover the common control also. Okay. So step number 1, in case of demerger without common control, nobody controls the resultant company also. Nobody controls the resultant company also. So now step number 1, first you check whether demerger exists or not. A demerger will exist if a new company is formed. Condition number 2, this new company will take over assets and liabilities of existing company. Consideration will be paid by the new company to the shareholders of existing company. Student have to note down, this is really very important we are discussing. So demerger, if it is demerger then discuss this, otherwise not. New company will be formed, new company will take over the assets and liabilities of the demerged company and the consideration is paid to the shareholders of the demerged company. So for example, if Reliance company demerges Jio and Jio issues shares to shareholders of Reliance, then this is demerger. This new company Jio will be called resultant company This existing company Reliance is called demerged company. Then we have to check common control. Very important for exam. Common control means the resultant company and demerged company effectively remain under control of the same party, control or joint control of the same party. Then it is a case of common control. We will apply Appendix C of Ind AS 103. If it is not common control, go to the step number 3. Go to step number 3. Accounting treatment when none of the shareholders control demerged company. No shareholder has more than 50%. So first of all, think from resultant company point of view. The resultant company means the new company. The new company is acquiring a business. The new company is acquiring a business. It will simply apply Ind AS 103 business combination accounting. Sometimes they will ask you to pass entry in the books of old company also. Old company will treat it like a dividend distribution to its shareholder, because old company is transferring assets and liabilities to resultant company and which is issuing shares to the shareholder. So old company will treat it like a dividend distribution as given in Ind AS 10 and Ind AS 105. Now please remember, if you have compact book, then you highlight that reserve and share capital is not transferred, even though division wise share capital or reserve is given. To confuse you, they will give you two columns. One is Maxi Limited, second is Mini, and in Mini they will give you reserve also, but we are not going to transfer reserve or share capital. We are only going to transfer assets and liabilities. Now the next part, common control transaction. Now please remember, very important, it is an important carve-in. IFRS 3 does not deal with common control transaction. It is Indian creativity, because Indians are highly creative. Ask my friend, okay, Adani ji, he will tell you, I treat him as my friend. He may or may not treat me. That is a separate issue. So common control transaction means when the same entity or same set of person control or jointly control the two entities before also and after also. Then this is called common control transaction. That means effectively nothing has changed. The controller remains the same. The controller remains the same. So if A has got two subsidiaries B and C, so A is controlling B and C. Suppose they merge B and C. Now they will have two entities A and B. But earlier also A was controlling A, B and C. Now it is controlling B. So same resources are controlled by A. This is called common control transaction. Since the control has not changed, the accounting system is also designed in such a manner that you cannot have an impact on the balance sheet. You cannot have a major effect on the balance sheet. Otherwise, by doing all such transaction, you will be able to increase the value of your company, the net worth of your company, and you can increase the market value, and you can make fool of the investors. So such transaction should not be transitory. Transitory means it should not be a part of acquisition and common control in nature. This I will explain later. Suppose a transaction comes under common control transaction. What about the accounting entries? Very important. This is similar to amalgamation in the nature of merger in your intermediate AS 14. Asset liability reserve from transferee company will be transferred at book value and difference will be recorded in capital reserve. So all items, asset, liability and reserve, will be recorded at book value. If any consideration is receivable, then this should also be recorded. So I'll give you a set of entries. not given in your institute study material. Pay attention. Two companies are there, okay, A and B, but the transaction falls under common control transaction. So in the books of B, that is the seller company, they have to remove from their books liabilities debit. They have to remove from the book reserve and surplus debit at book value, buyer company account debit, any agreed consideration, to asset account at book value. So there can be some difference here. That difference will be adjusted in capital reserve, not in goodwill. That difference will be adjusted in capital reserve, not in goodwill, because you are not acquiring a business, you are selling a company, so goodwill will not arise, and then you will receive the consideration cash or investment account debit to buyer's company account. Then in the books of buyer company, very important, they will also record at book value asset account debit at book value, to liabilities account book value, to reserve and surplus book value, to vendor company purchase consideration payable. Any difference is adjusted in capital reserve, not in goodwill, because this is common control transaction. And then you will make payment to the vendor. The entry will be vendor account debit to share capital account to cash or bank account. This method of accounting in common control transaction is called pooling of interest method. Example of common control transaction: merging of subsidiary with the parent. And second example is, which I had given you, merging of one subsidiary with another subsidiary. So dear student, I have made a very useful summary of pooling of interest method. You can get two types of question here. One is question on demerger and question other than demerger. You will be asked entries in the books of seller, you will be asked entries in the books of buyer. So in the books of seller, if it is demerger, the entry will be transfer assets and liabilities. In case of demerger, please note, demerger, it is one company, a division does not have reserve. Do not transfer reserve in demerger. Do not transfer reserve in case of demerger. No consideration is received by the seller. The consideration is received by the shareholder and the difference is adjusted in capital reserve. But if it is a problem of common control other than demerger, it means a subsidiary is merged with another subsidiary, then the selling company will transfer asset, liability and reserve. Consideration receivable entry will be passed, difference adjusted in capital reserve. What about buyer? If it is a case of demerger in common control transaction, they will record asset and liabilities, but they will not record reserve because a division does not have reserve on its own. Consideration payable to members will be recorded. Any difference will be adjusted in capital reserve. And if it is any other case, highly tested in the exam, both situation, highly tested, you can take a snapshot and keep it in your notebook. So if it is other case, you will record asset, liability and reserve, consideration payable is recorded and capital reserve is recorded as difference. Do not record goodwill. Now this is highly tested in the exam. The institute gives you question like this: there are two companies A and B. A new company AB is formed, but A has control previously over B and now over AB. So this may be a common control transaction. In that case, you have to issue number of shares. Question mentions number of shares issued to each company. If the problem says number of shares to be issued to each company, issue the number of shares as per the question. If the question does not give you number of shares to be issued, then we are going to calculate number of share to be issued on the basis of the ratio of net asset. On the basis of ratio of net asset, we are going to issue the number of share to the two companies. If the question does not mention, this was asked in recent exam also, then the number of share will be based on the ratio of net asset. Now the last part of this chapter, reverse acquisition. Reverse acquisition means it may appear that A has acquired B, but in reality B has acquired A. But in reality B has acquired A. That is the case of reverse merger. Okay. So legal acquirer and accounting acquirer will be different. In the eyes of law, A is acquirer, legal acquirer. But for accounting purpose, B is acquirer, whom we will call accounting acquirer. Whom we will call accounting acquirer. So how do you identify whether it is a case of reverse acquisition or not? This is one small challenge before the student in the exam, and last 4 or 5 years or 3-4 years, at least 3 to 4 times they have asked question on reverse acquisition. Sometimes it is explicitly mentioned in the question that it is a case of reverse acquisition. Enjoy. Please excuse me for a minute. Sometimes question will mention reverse acquisition. Sometimes they will be giving you some hint like small entity takes over a larger entity. But we as a student, we will do this calculation if nothing is given, that who holds higher number of shares in the post combined entity. I will calculate the number of shares held by legal acquirer in the merged entity. I will calculate the number of share held by legal acquiree in the merged entity. Suppose this is 40% and this is 60%. Suppose in the merged entity this is the respective shareholding. If the legal acquiree is holding more share in the merged entity, then that will be called accounting acquirer. So this will become accounting acquirer, and we have to do the accounting as if this entity has acquired this other entity. So you have to think very differently. So the one who holds larger proportion of share, that entity will be treated as accounting acquirer. So how to do the accounting? Once you are sure that it is a case of reverse acquisition, then pass the following entries. Before passing the following entries, make the balance nil of all the ledger balances of legal acquirer. Entries will be passed in the books of legal acquirer, but you have to assume that we are passing entry in the books of accounting acquirer. So in the books of legal acquirer, first you make balance of all the ledger 0. How do you make the balance 0? Assets will be credited at book value, liabilities will be debited, reserve will be debited, share capital will be debited at book value. So make the balance 0. Now you will take the asset and liabilities of the accounting acquirer at book values. You will take the asset and liabilities of accounting acquirer at book value. Sundry asset debit at book value, liabilities credit at book value, reserve credit at book value, and share capital at book value. So basically you are going to bring all asset, liability, reserve, share capital of the accounting acquirer at book value, and then you will calculate PC. It is always equal to fair value of the accounting acquiree. Any consideration given in question will be ignored. Now you are going to record asset, liability, reserve, asset and liabilities of the accounting acquiree or legal acquirer at fair value. Asset account debit at fair value, liabilities at fair value to vendor purchase consideration. Any difference will be adjusted in goodwill or capital reserve. Vendor account debit, purchase consideration, this figure, to share capital, to securities premium. So this is how the entry will be done. If the question specifies new number of shares in legal acquirer, if the question gives you new number of shares in legal acquirer, then do not recognize share premium in the above entry. Then don't recognize share premium in this entry. If the number of shares of legal acquirer are given, rather you make a change in the paid up value of the share. So paid up value per share will be total share capital divided by total number of share. If the question does not give you any limit on the number of share, then assume old paid value and fair value of share. Assume old paid value and fair value of share. Number of share to be issued will be, in case of reverse acquisition, if the institute does not give you number of share, then the number of share issued will be purchase consideration divided by fair value of accounting acquirer. Very important. In 1 or 2 exams, student who have appeared will remember this question was asked in a reverse acquisition. Now the last part is EPS in case of reverse acquisition. A, B. A is accounting acquirer. B is accounting acquiree. You will consider number of shares of accounting acquirer from the beginning of the year, and you will consider the number of share of accounting acquiree from the date of acquisition, and here you will take it from the beginning for the purpose of calculating weighted average number of shares. So dear student, this was a presentation on Ind AS 103. You can purchase this book called Financial Reporting Compact Book, available on website vinod.in, where the same presentation is there and very good for last minute revision. For numerical question, you can purchase this compiler book which contains question and answer from study material, all RTP, all MTP, all past exam, and some good reference books also. In addition to that, I have prepared one book called Class Note with Solution book. This book is one of the best books in the country on financial reporting. It contains theory and problem, topic wise, concept wise, and the way we solve the answer in the classroom step by step with all the notes and explanation written is covered in this FR Class Note with Solution. So student can purchase this book from our website. Right now we are offering it at 30% discount. So go to our website vinod.in and you can purchase FR Class Note with Solution. Those who have purchased video lecture can also purchase this book. They will get all the answer as solved in the class in the printed form. Very useful book for CA student also, CMA student also, and student preparing for any exam which requires the knowledge of Ind AS or IFRS. So thank you very much for watching this video lecture. I am really grateful to you. My only request is please subscribe to the channel AS Foundation. Any query you can message on WhatsApp number or email ID. For more details you can go to website vinod.in. I wish you all the best for the student appearing in this coming exam or the next exam. Thank you very much. Hello, good evening friends. Please come to Ind AS 32. Ind AS 32 is financial instrument presentation, and as you know, this is one of the most important standards in our syllabus. If you understand this standard, then you will be able to understand other standards like Ind AS 109. Plus there is a reference of this standard in other standards also like Ind AS 12, etc. So we are going to quickly go through all the important provisions of Ind AS 32. So are you ready? So what is the basically requirement of Ind AS 32? The requirement of Ind AS 32 is it first deals with classification of financial instrument into financial asset, financial liability and equity instrument. So whether an instrument will be financial liability, financial asset or equity. That is one of the major tasks in this standard, and that is what we will learn as we'll go ahead. Then the next is, can financial asset and financial liability be offset for presentation purpose in the balance sheet? So can, for example, debtor and creditor be shown net of each other in the balance sheet? So that is the question we'll discuss. And then this standard also deals with the treatment of interest, dividend, gain, losses, interest, dividend, gains and losses in the financial statement. So our objective is whether a financial instrument is financial asset, financial liability or equity, whether financial asset and financial liability can be set off against each other for presentation purpose. And third is, what will be the treatment of interest and dividend, gains and losses in the profit and loss account and SOCIE. So let us first deal with the definition of financial instrument. What is a financial instrument? What is a financial instrument? A financial instrument is a contract. So first feature of financial instrument is it should be a contract. The contract should give rise to financial asset for one enterprise, and it should give rise to financial liability or equity instrument of another entity. For one entity it is financial asset, for other entity it should be either financial liability or equity. If this condition is satisfied, then this is a financial instrument. So what is the important feature of financial instrument? It is important that there must be a contract. There must be a contract. So income tax liability is not a financial instrument because there is no contract. It is a statutory liability. It is a statutory liability. Income tax liability payable is not a financial instrument. In a financial instrument, there are two parties involved. Who is the first party? The first party is the issuer of the instrument. The first party is the issuer of the instrument. The entity which has issued the financial instrument, either it will present it in the balance sheet as liability or equity. The issuer will show financial instrument as financial liability or equity, and the second party is called the holder of the instrument. The holder of the instrument will call it as a financial asset in the balance sheet. So I'll give you some example to understand financial asset and financial liability or equity. For example, one party will show debtor, the other party will show creditor. One party will show cash, the other party will show, or it is a liability of RBI. So cash is a financial asset for one party and it is a liability for RBI. Then investment in equity share. Suppose one entity has invested, it is a financial asset. For the other entity, the one who has issued the equity share, it will form part of equity. Then investment in redeemable preference share is financial asset for one party. Issue of redeemable preference share capital is a financial liability or equity for the other party. Bank balance is financial asset in our book and it is a financial liability in the books of the bank. Now there are some contracts which are receivable or payable, but these are not financial instrument as per Ind AS 32. So they may be receivable or payable, but these are not financial asset or financial liability as per Ind AS 32 or Ind AS 109. So this is a list of exception, that is, on these items Ind AS 32 will not apply. What are these items? One is indemnification asset, that is amount recoverable from another party in case of loss. Ind AS 37 is applicable. Rights and obligation under employee agreement, Ind AS 19 is applicable. Share based award, Ind AS 102 is applicable. Investment in subsidiary, associate, joint venture. If the entity selects the option to record on underlying cost basis, investment in subsidiary, associate, joint venture can be recorded either on cost basis or fair value basis. If they are recorded on cost basis, this standard is not applicable. Then agreement made for business combination are out of the scope. Deferred consideration is covered within the scope of this standard. Deferred consideration means consideration payable at a later date will be covered. Insurance contract, Ind AS 104. Contract assets and liabilities covered by Ind AS 115. So Ind AS 115 also we had covered in our discussion. Then lease receivable and lease payable at the inception of the lease will be covered by Ind AS 116. So accounting of leases initially will be covered by Ind AS 116. What about subsequent treatment? Subsequent treatment will be covered by this standard. For example, impairment of lease will be covered by Ind AS 109. Certain loans and financial guarantee contracts. Certain loans and financial guarantee contracts will be covered by Ind AS 104. And certain executory contracts, not all executory contracts, some executory contracts are outside the scope of this financial instrument standard and some executory contracts are within the scope of financial instrument standard. So there will be a question on this part in the exam, that whether this executory contract will form part of financial instrument standard. So for that I am going to tell you some important hints. Likely question from executory contract. Executory contract means contract to buy or sell any non-financial item which is needed for the usage requirement of the entity. For example, a company which requires cement may enter into a future contract, forward contract to buy cement. Company which are suppose printing books, they may enter into a future or forward contract to purchase paper. So these are executory contract. A contract entered today which will be executed in future, whether this will be covered within the scope of this standard or not. Please reply whether this will be covered by the standard or not. So here my answer is First we'll apply what is called past practice test. Like, I am a teacher. I have nothing to do with paper or steel or cement. I have the practice of entering into such contract in net cash settlement. That means I only receive or pay the difference. I am really not interested in steel, paper, cement, milk, copper. Okay. If the entity has past practice for quick buying and reselling of non-financial item, the other possibility is I buy and sell immediately. There is no time gap or no major time gap between buying and selling such non-financial item. My objective is to make a quick profit. Due to price changes. So I buy it and I sell it and I corner the price differences. Then what we will do? In such cases, past practice test has been satisfied. So one, I have the history of net settlement. Second, I have the past practice of buying and selling it immediately to make quick profit. Past practice test has been satisfied and I will account for such executory contract under financial instrument standard, because I am really not interested in the underlying non-financial asset. I am not interested in paper, I am not interested in cement, I am not interested in steel. I am interested in making quick profit. So they will be treated under this standard. Second test is whether contract permits net settlement. Does contract allow you to make net settlement and the entity intends to settle the contract on the net basis? Whether the entity wants to settle the contract on the net basis. If the answer is yes, the contract allows net settlement and the entity intends to settle on net basis, then also condition of Ind AS 109 is satisfied and the standard will be applicable. Other executory contract are outside the scope of Ind AS 109. Then what will be the treatment of such executory contract which come under the scope of Ind AS 109 or Ind AS 32? This kind of contract will be treated as a derivative contract, a derivative asset or a derivative liability, which means they will be treated like a forward, future or option contract. Point number E, entity has an option to designate its contract within the scope of Ind AS 109. So one more situation when you can apply 109, when there is a choice to settle on net basis. When there is a choice to settle on net basis and the entity has an option, the entity is given a choice, it can designate the contract as within the scope of 109. So what is the difference between this point and this point? Both look similar. In this point, the top point, the entity intends to settle on net basis. In the last point, the entity has an option to designate it as a derivative contract if it has the option of net settlement. Now we'll come to the meaning of financial liability. The student are wondering where we will get the notes. So dear student, these notes are from this book which is called Financial Reporting Compact Book. We have prepared this wonderful compact book which contains the entire theory in very simple words. You can easily understand. Institute material is full of complicated language, jargons, difficult sentences. We have bifurcated that into simple sentences in small paragraph. Plus I have also given journal entries that is required to be passed whenever you have a question of journal entry. All Ind AS are covered in this booklet. Very useful for last minute revision. You can get it on our website vino.in. In addition to that, there is a summary chart also. If you want to revise your entire syllabus in say 2 to 3 hours, one day before the exam, you can purchase this summary chart book from our website vino.in. Very useful for last minute revision in simple language, chart format. This book is available. Thank you. And now let us come back to the meaning of financial liability. This is one of the little complicated part of the standard, but trust me, if you pay attention, you'll be able to understand. A financial liability is a liability which qualifies any of the following 4 elements. Any of the following 4 elements. Again, a highly tested area in the exam. They will give you a situation and the student has to answer whether this situation is a financial liability or not. So you have to check for whether any of the following 4 elements are present. We will call it element. So first element number 1, financial liability is a liability which is having a contractual obligation. So first see whether there is a contract. Income tax liability is not a financial liability because there is no contract. It is a statutory liability. The contractual liability should be to deliver cash or any other financial asset. The contractual liability should be to deliver cash or other financial asset. For example, bank, financial asset example, bank, bills receivable, investment, etc. If there is a contractual obligation to provide goods, or service, then it will not be a financial liability. For example, warranty. In warranty, we have a contractual obligation to repair or replace. So that will not be a financial liability. So simple test is the contractual obligation cannot be avoided. The entity will be required to make payment in cash or other financial asset and it can't be avoided. Then the element number 1 is satisfied. Contractual obligation to deliver cash or other financial asset. Some examples of element number 1 financial liability is loan, debenture, trade payable, bills payable, expense payable. These are financial liabilities. Your stipend payable is also financial liability. Okay. Now we'll come to element number 2. Now as we'll go ahead, the definition will become little complicated. Element number 2 says a financial liability is a liability which has a contractual obligation. So this is common to exchange financial asset or financial liability in potentially unfavorable condition. In potentially unfavorable condition. So these are basically derivatives which have become unfavorable. Unfavorable means when you will settle it, it will result into loss for you. It will result into loss for you. So potentially unfavorable condition. These are derivative liabilities which may be positioned in unfavorable condition in future and will be required to pay in cash, bank, investment or equity. So suppose for example, you have entered into a future contract to buy share at 100 rupees. You have entered into a future contract to buy share at 100 rupees, but the future rate is now 90 rupees. It has gone down. So this future contract will become unfavorable because you have to buy one share for 100 rupees whose value has gone down to 90 rupees. So contract becomes unfavorable to you. Now element number 3. Element number 3 is, as we'll go ahead, a little more complication will arise. A financial liability is a liability which is a contractual obligation which is a non-derivative in nature. Non-derivative in nature. Contract is non-derivative. Remember, the second one was derivative, which is unfavorable. Third is a non-derivative contract which will be settled in own equity instrument. Non-derivative contract settled in own equity instrument which will be variable in nature. That means the number of equity share to be issued will be variable. For example, I have to pay a loan 10,000 rupees. I have to pay a loan of 10,000 rupees and I will settle the loan based on market price of the equity share. Number of equity share to be issued will depend on market price of the share. Number of equity share to be issued will depend on market price of the share. Now tell me how many equity share will be issued. If the market price of the share is 100 rupees, then 100 shares will be issued. If the market price of the share is 200 rupees, then 50 shares will be issued. The market price of the share is 1000 rupees, only 10 shares will be issued. So in that case, we will call it a financial liability. So the summary of this is non-derivative contract where the settlement will be based on own equity instrument and the number of equity instrument to be used will vary. Then in that case it will be a financial liability. And element number 4, whenever any contract which is derivative in nature. So element number 2 was also derivative, element number 4 is also derivative, but element number 2 was financial instrument which has become unfavorable. Element number 4 is derivative instrument settled in own equity instrument, like for example a future contract or an option contract which will be settled in own equity instrument, it will be recorded as a financial liability. So a derivative contract like option future which will be settled in the form of own equity instrument will be treated as a financial liability except in case of those derivatives which will be exchanged for fixed cash against fixed number of own equity instrument. Very important. So a derivative contract which will be settled in own equity instrument where a fixed amount of cash will be exchanged against fixed number of shares, then this will be equity instrument. But there is a fixed amount of cash and variable number of equity share, or variable number of or fixed number of share against a variable amount of cash, then that will be treated as a financial liability. So what is the exception over here? A derivative contract which will be settled in own equity instrument and it will be settled against a fixed amount in cash and a fixed number of equity share will be treated as equity instrument. So when all conditions are satisfied, we will call it as financial. Will any of the 4 conditions are satisfied, we will call it as financial liability. Now the student is asking, what is a derivative contract? The student is asking, what is a derivative contract? So derivative contract means when following conditions are satisfied as per this standard, then that contract will be treated as derivative. So first is derivative means contract whose value will change as the value of the underlying will change. For example, index future, as the index value will change, the value of future will change. Gold future, as the value of gold will change, the value of that contract will change. Call option on Infosys share, as the Infosys share price will change, the value of call option will also change. Second condition is it requires no investment. For example, forward contract may not require any investment or may require a very low investment, like option contract. You have to pay a premium amount which may be some percentage of the total value, or in future contract you may have to deposit some margin money. As compared to the value of the contract, the amount to be paid is very low. And the third feature of a derivative is that it will be settled at a future date. A derivative contract is settled at a future date. So when all the three conditions are satisfied, then it is a derivative contract as per the standard on financial instrument. So I'll repeat, its value will change due to change in the value of underlying. It will be settled at a future date. It requires either zero investment or very low investment. Example of derivative, your SFM syllabus, options, call, put, future, that is which are traded on exchange, forward contracts which are over the counter derivative, and swap contract which are, example, interest rate swap, commodity swap. Sir, what are these items? This you will study in your SFM syllabus. Okay. So dear student, we teach two subjects for CA final, SFM and FR, and I have recorded the lectures in English and full Hindi. So if you want to purchase this comprehensive lecture on FR and SFM, you can purchase from our website vino.in. This is our website, and you will be able to easily find out FR SFM by CA Vinod Kumar Agarwal. I highly recommend, because we have taken lot of efforts to prepare this lecture, record this lecture, and you can either purchase regular lecture which will cover full syllabus in detail, or you can purchase revision lectures which will be like theory will be fully covered but the number of problems will be limited. So FR SFM regular and revision video lectures are available in English and Hindi. Probably we are the only academy, we are providing in both the languages regular lecture also and revision lecture also at a very low price, so that maximum number of students can get the benefit. Now the next question is, when should financial liability be recognized? When should financial liability be recognized? When should be the liability be brought into the books of account for the first time? So the answer is, financial liability will be recognized when the entity becomes party to it. When the entity becomes party to it means when the contractual obligation can be enforced by the law. So when the entity becomes party to a contract, then in that case financial liability is recorded in the books of account. Now another question is, what are the types of financial liability as per this Ind AS 32? So financial liabilities are two types only. Financial liabilities are only of two types, FVTPL and amortized cost. FVTPL means fair value through profit and loss account. So at the inception, at the beginning, when you are recognizing financial liability, you have to decide whether it will be FVTPL or amortized cost. Falling financial liabilities will always be treated as FVTPL. So check this one. If it fits into the falling financial liability, it will always be FVTPL. And if it is not FVTPL, then it will be amortized cost. So which are the financial liability which will always be treated as FVTPL? Derivative liabilities. Derivative liabilities will be treated as FVTPL. Financial guarantees and loan guarantee contract. Financial guarantee and loan guarantee contract will be FVTPL. Contingent consideration. Contingent consideration means consideration payable on future event. You will study in Ind AS 103 contingent consideration. This will be always treated as financial liability. And fourth is accounting mismatch. This I will discuss at the end of this chapter, so you keep watching this video till the end. Accounting mismatch. So I will revise again. Only in these following cases a financial liability is FVTPL. Derivative contract, financial guarantee or loan guarantee contract, contingent consideration, and accounting mismatch. So if it is not fitting into this four, then those financial liability will be treated as amortized cost. If it doesn't fit into this four, then other financial liability will be treated as amortized cost. So let us understand the accounting of financial liability. Very important, highly tested in the exam. Kindly pay attention. So yes, let us understand accounting. We have understood the definition part. Now let us come to the accounting measurement part. At the beginning, at the inception, financial liabilities should be measured at fair value. At the beginning, financial liability will be measured at fair value. Now what is fair value in the case of financial liability? Fair value means proceeds minus transaction cost. So for example, you have taken a loan of 10 lakh and 10,000 rupees was transaction cost, brokerage. So you will say the fair value is 9,90,000. Proceed minus transaction cost. Fair value is proceed minus transaction cost. Now next, some important points to be kept in mind. If financial liability is short term in nature, so usually your creditor, bills payable, short term borrowing which is below 1 year, then these are not discounted. These are not discounted. No discounting, no complicated accounting required. Simply the difference between the settlement amount and the book value will be transferred to P&L account at the time of settlement. But if the financial liability is long term in nature, that is the amount will be paid after 12 months, then it should be discounted. Then it should be discounted. Fair value is considered at discounted value. Here, effective rate of interest should be calculated for accounting purpose. Effective rate of interest means IRR. IRR will be calculated. So you will calculate fair value in the beginning. You will see what are the cash flows you have to make over a period of time. Find out that discount rate. Find out that discount rate at which the present value of the future cash flow is equal to the fair value today, and that discount rate is called EIR or IRR, effective interest rate or internal rate of return. One more thing, if you are showing financial liability at amortized cost, if you are showing financial liability at amortized cost, it will not be subsequently remeasured. Financial liability at amortized cost is not subsequently remeasured. So to make your life easier, if the category is amortized cost category, if the category is amortized cost category, the entry at the inception will be bank account debit to financial liability account. Bank account debit to financial liability account, and the amount will be equal to proceed minus the transaction cost. At the end of the year or every interest payment date, you will create a liability borrowing cost account debit to financial liability account, and this is calculated using effective interest rate. This will be calculated using effective interest rate. So opening liability you will take multiplied by effective interest rate, that will give you the borrowing cost. This amount you will record. Highly tested in the exam. Sometimes they will say that company has recorded the interest based on actual payment. We don't record on the basis of actual payment. We will record by applying effective interest rate on the opening balance. Any payment made will be debited to financial liability account, to bank account, and if settled in case of paying in the form of equity instrument, then to equity, being amount paid. Some care we have to take is borrowing cost will be transferred to P&L account. Borrowing cost will be transferred to profit and loss account. However, you have to also see Ind AS 23. Ind AS 23 borrowing cost. If they permit capitalization, then you can capitalize it. Second, in the balance sheet, the financial liability will be treated as a non-current liability or current liability. In balance sheet, financial liability will be non-current or current depending upon the due date of the payment. If the amount is payable within 12 months, that portion will be treated as current, and if the amount is payable beyond 12 months, that portion will be treated as non-current. Next is treatment of zero coupon bond or deep discount bond. These bonds do not pay the principal amount only. So these bonds do not pay interest amount, only the principal amount is paid on maturity. Still, they will be treated as financial liability because there is a contractual obligation to pay the principal amount. They would be treated as amortized cost instrument, and the company will follow effective interest rate for accounting of zero coupon bond. Another special situation is perpetual bond or non-redeemable bond. These bonds do not have a maturity date. Only coupon will be paid. Principal amount will not be repaid. So whether these are financial liability or not. So what we will do, we will check the financial liability by how much is the coupon paid periodically divided by the market rate of interest. This portion will be treated as financial liability. Remaining amount will be treated as equity. So perpetual bond can be a just financial liability, or it can be a hybrid instrument which may contain equity also. So financial liability is the present value of the future interest payment. If there is a difference between the fair value and the present value of the future interest payment, then that portion will be treated as equity. Here split accounting is applied. Split accounting means we will have to find out how much is the financial liability, how much is the equity. So this is how perpetual bond will be solved. Now next question is whether preference share, very important because of the standard on financial instrument in India. Now there is a big change in the accounting of preference share. When you are in 11th standard, 12th standard, CPT, foundation, intermediate, you have shown preference share along with equity share in the balance sheet. But now the situation has changed. A preference share can be a liability instrument. In that case, it will appear in the current or non-current liability section of the balance sheet. or it can be a equity instrument also, or it can be a compound instrument also, depending upon how that preference share is designed. Okay, so if preference share are redeemable, if the principal amount, the face value is redeemable, then that part of the preference share will be a financial liability because there is a contractual obligation to pay cash. If preference shares are irredeemable, that means there is no contractual obligation to pay principal amount, then that part is treated as equity instrument. If preference shares are entitled to mandatory fixed dividend, underline mandatory fixed dividend, company has to pay, there is no choice, then mandatory fixed dividend payment, that part will be treated as financial liability. Some more example on preference share. You have to participate and answer. Preference shares are entitled to cumulative preference dividend, cumulative fixed dividend. I will give you 100 rupees if you give me correct answer. Preference share are entitled to cumulative fixed dividend, whether this entitlement to cumulative fixed dividend is a financial liability or equity, whether it is financial liability or equity, whether it is a financial liability or equity. Now the students are thinking it is a financial liability, but the answer is it is equity. Why? Because company may not pay, company can keep on deferring forever. Okay, company can keep on deferring it. That means there is no contractual or mandatory obligation to pay. It will just keep on accumulating. So it will be treated as equity. Next question. Yes, please reply. Preference shares entitled to non-cumulative fixed dividend. Non-cumulative means it will not accumulate. So that will also be treated as equity instrument. Okay, question for you. This can be exam question, whether following preference shares are equity or liability. Third, preference shares are entitled to dividend linked with ordinary share. That is, if dividend is paid to ordinary share, then dividend will be paid to preference share also. Is it liability or equity? Is it liability or equity? The answer is equity, because dividend payment on equity share is not obligatory. You can indefinitely postpone the payment of dividend on equity share, and therefore you have indefinitely postponed the payment of preference share. Next question. Preference shares are convertible into, underline, fixed number of share. If preference shares are convertible into a fixed number of share, that means fixed cash against fixed number of share, then that part is treated as equity instrument. If preference shares are convertible into variable number of equity share, so here fixed cash was received, but variable number of shares will be issued, so then that part is called financial liability. If preference share is redeemable and dividend is non-cumulative, so this part is liability and this part is equity. So an instrument which has both the features of equity and liability, such instrument is called compound financial instrument. Such instrument is called compound financial instrument. So if a preference share is redeemable and the dividend is non-cumulative, so there are two elements. One is the redemption of the principal amount, which cannot be avoided, so liability, but dividend can be avoided, so which is equity. Equity plus liability, it is called compound financial instrument. Another important question for exam purpose could be FCCB. FCCB means foreign currency convertible bond. So dear student, if you are watching this video, please like the video and most importantly subscribe to this YouTube channel AS Foundation, please immediately subscribe and also share with your friend, because we are going to come out with more video lecture on FR short revision, where in almost 1 hour we will be able to revise one standard in a day. So now an important discussion is FCCB. It is a carve out. A carve out means a major difference between Ind AS and IFRS. So FCCBs are treated differently in our standard Ind AS 32 and IFRS standard number IAS 32. Now whenever a company issues bond, which is a foreign currency convertible bond, there is an equity conversion option or right. That means the holder will get a certain number of equity share. Holder will get a certain number of fixed number of own equity share, and these bonds were issued in foreign exchange. These bonds were issued in foreign exchange. So this will come under the definition of a non-derivative contract, element number 3 of financial liability as per Ind AS 32. It is a non-derivative contract which will be settled in fixed number of own equity share. A non-derivative contract which will be settled in fixed number of own equity share as per our Ind AS 32. If it is settled in fixed number of own equity share, then it is equity. But what the International Standard 32 says, International Standard 32 says, okay, you are issuing a fixed number of equity share, but the amount of cash is not fixed because the foreign exchange rate is changing. As the foreign exchange rate is changing, the consideration is not fixed. Number of shares are fixed, consideration is not fixed, and therefore we will call, that means IFRS will call it as a financial liability. The IFRS calls it as a financial liability. So this was about financial liability and equity. Now we'll deal with what is financial asset. Just for your information, Ind AS 32, the major focus is on financial liability and equity, and in Ind AS 109 the focus would be more on financial asset. But in the standard Ind AS 32, we'll just have a quick discussion about the definition of financial asset. Okay, a financial asset has following 6 elements: 1, 2, 3, 4, 5, 6. If any of the 6 elements are present, then we will call it as a financial asset. Cash by definition is a financial asset, because RBI has issued the currency note. So financial asset for you and liability of the RBI. Then equity instrument of another entity. If you are holding equity instrument, equity share, for you it is a financial asset, for the other party it is equity. Then contractual right, it should be a contractual right to receive cash or other financial asset. The student will remember this was element number 1 in financial liability, where it was written a contractual obligation to pay cash or other financial asset. So this is the way to remember, except the first and the second one. The remaining 4 are similar to the 4 elements you have studied in financial liability. Fourth point is, it is a contractual right to exchange financial asset or financial liability in potentially favorable condition. These are derivative. So for one party, a derivative would be a financial asset, and for the other party, derivative would be a financial liability, because for one party, when the derivative turns favorable, for the other party, the derivative turns unfavorable. The next element number 5, contract which will be settled in own share, which are non-derivative in nature, and the entity will obtain variable number of shares. Similar to element number 3 of financial liability, non-derivative contract which will be settled in variable number of own equity shares. And the last one is contract will be settled in own share that are derivative in nature and which will be settled in other than fixed cash for fixed number of shares. So these are exactly reverse. The last one is non-derivative contract which will be settled in variable number of equity share or variable cash, but not fixed cash against fixed number of shares. If any of these 6 elements are present, then that contract will be a financial asset and the entity will apply Ind AS 32 and Ind AS 109 for accounting, measurement, recognition, and Ind AS 107 for disclosure purpose. Now, what is the meaning of equity? What is the meaning of equity? We have seen financial liability, 4 elements are there. We have seen some special cases of financial liability. We have seen financial asset, there are 6 elements. More about financial asset in another standard. More about financial asset in another standard. Ind AS 109. Now next is the definition of equity. Okay. One student is asking example of point number 4 and 5. Point number 4 example is, suppose you are holding a future contract and you have long position, you have bought future and the price has gone up, then it is favorable for you. Okay. And contract which can be settled in own share are non-derivative in nature and will be obtained variable number of share. So for example, some loan is given to other party and it will be settled by giving back to you your own share, but the number of share will be issued will be based on market value of the share. So if I have given you a loan of 10,000 and you are going to return my share, but the number will be based on market price. So I am going to get variable number of shares. So that is a non-derivative contract settled in variable number of own share. Right? We'll come to definition of equity. Equity shareholder is the last person in the queue. Suppose this is the queue which starts from here. This is the last person in that queue, that is equity holder. A contract that evidences residual interest in the assets of the equity after deducting all the liabilities called equity. That means assets minus liabilities. First the asset will be used to pay all other liabilities and whatever is remaining is called equity. They have a residual interest. They are the last person to receive their amount. So now the question is, what are the financial instrument or components of financial instrument which will be treated as equity? One is ordinary share. Don't write equity share, write ordinary. Ordinary share means no preference of any kind. No preference of any kind, whether it is payment of dividend or redemption or anything, then it is called ordinary share. Ordinary shares are equity instrument. Then second is those instrument or component which pass fixed test. Those instrument or component which pass fixed test means fixed number of cash will be received against fixed number of equity shares. Fixed cash, fixed equity share is equity instrument. Those instrument or component which passes fixed for fixed test. So this will be a non-derivative contract and this will be a derivative contract. That means fixed cash and fixed number of equity share And then there are deemed equity, which is given in para 16A to 16D. This I will discuss later. Deemed equity means they have the feature of financial liability and they have the feature of equity also. So the standard says you please call them deemed equity only, and they will be treated as equity instrument. So this we will discuss later. So if an instrument has feature of both financial liability and equity, if an instrument has feature of both financial liability as well as it qualifies for deemed equity, then the standard says it will be deemed as equity instrument. So like for example, we'll discuss after some time conditions for deemed equity. Putable instrument. What is a putable instrument? The investor can surrender the bond before maturity and can get cash. That is putable instrument. Or instrument which obligates to deliver pro rata share of net asset on liquidation. That means the holder of the instrument will get pro rata share in net asset, but at the time of liquidation. So he is getting cash also, but that cash is paid at the time of liquidation. Such instruments are treated as deemed equity. Second condition is such instruments are most subordinated instrument on liquidation. Most subordinated instrument on liquidation, that means they will be paid after all other liabilities have been paid. Such instruments are entitled to share in net asset only. So this instrument will get share in net asset and they should not have any limit. So whatever is the net asset, they will get a share in that, which can be very high, very low. Then such instruments should have identical features, and these instruments have no other right like right to convert or any other special redemption right. No special right attached to such instrument. Total cash outflow on such instrument should be based on profit and loss of the entity. Cash outflow on such instrument is based on profit and loss of the entity. And point number G, entity should not have another contract which is not at arm's length with such instrument holder. The last line probably is not appearing on the screen. That means there should not be any other contract with the same holder which is not at arm's length. So that means there should not be the benefit transferred in any other form. If these conditions are present, then the instrument will be treated as deemed equity and will be accounted as equity instrument, not as a debt instrument. Another question is set off of financial asset against financial liabilities. Can financial asset and financial liability be set off against each other for presentation purpose? The answer is yes, if two conditions are satisfied. Condition number one is there is a legally enforceable right to set them off, and condition number two is the entity intends to settle on the net basis. There must be legally enforceable right. The law of the land must allow net settlement. If you have an importer and exporter in foreign country, then the law does not allow you to settle on net basis. From importer you will get money, to exporter you have to pay money separately. But suppose this debtor and creditor is within the country, then you can do the set off, but at the same time the party must intend to settle on net basis, or even if not on net basis, assets and liabilities are settled simultaneously. That means at same point of time one party will receive and one party will pay. Okay. Now next is treasury shares. What we call buyback of own shares. In India we call it more popularly buyback of own share, but in foreign countries when you buy back own share, they are called treasury shares. In some countries they allow you to hold your own shares also. So the shares which are bought back are called treasury share, Whenever entity receives or buys back its own share, then what we will do, accounting treatment, we will cancel the equity. It is cancellation of equity. Reduce your equity. Profit or loss will not be recognized in P&L account. Profit and loss will not be recognized in P&L account. Rather, it will be adjusted in equity only. Consideration paid or received will be recognized directly in equity. Such treasury shares may be acquired and held by the entity or by the members of the consolidated group. Sometimes a group member may acquire share in another group, another member in the group. One group member may acquire share in another group member. Then at the time of consolidation, they will be cancelled. The investment in the equity share will be cancelled and the share capital will also be cancelled. So while preparing consolidated financial statement, consideration for treasury shares acquired and held by other members of consolidated group is deducted from equity. Institute has so far not asked question on treasury shares. What is the treatment of dividend, interest? If the dividend or interest is paid on financial liability, it is treated as expense. If the dividend or interest is received on financial asset, it will be treated as income in P&L account. If any transaction cost on equity will be incurred, like issue expense, then it will not be recognized in P&L account. It will be adjusted directly in equity. For example, share issue expenses. But if you incur transaction cost on equity and the equity instrument is not issued, then it will be written off in profit and loss account. One important thing, equity is never remeasured. Equity is never remeasured. Some examples of income and expense. Interest payment on bond is expense. Is expense, will go to P&L account. Dividend on preference share, which is classified as a financial liability, is an expense, P&L account. Gain and losses with redemption or refinancing an instrument classified as a financial liability is an expense which will go to P&L account. Gain and loss relating to carrying amount of an instrument which is a financial liability will be transferred to profit and loss account. So the summary is, if the instrument is classified as a financial liability, the corresponding interest, dividend, gain, loss will be transferred to profit and loss account. Okay. But if the instrument is classified as equity, then the dividend payment will be adjusted within equity. Then you will directly adjust in SOCIE. You will reduce from reserve in SOCIE. Similarly, if there is any incremental directly attributable cost incurred on issue of equity instrument, already discussed, like transaction fees, regulatory fees, they will be adjusted directly in equity. When I say directly adjusted in equity, it means it will be adjusted against reserve and surplus items like general reserve or retained earning in equity. One more important part is compound instrument. Okay, so you will not be able to see the heading, but I will explain now. We are going to discuss what is called compound instrument. Very, very important. Okay, very, very important. When you go to exam, read this part. I'll just tell you, this is the book called Financial Reporting Compact Book, unique book. you'll find only on our website vinod.in, and it covers your entire Ind AS in very simple language, very useful for CA student, CMA student, even those who have qualified the exam, they can refer this book, one-stop solution for Ind AS. So, accounting treatment of financial liability under amortized cost method. When we are given a question, we need to check step 1 whether it is a pure financial liability or it is a hybrid instrument. Now, how do we know whether it is a hybrid instrument? A hybrid instrument is also called compound financial instrument, and it will have two components. Component number 1, financial liability, and second component is equity. Financial liability component will be accounted as per the standard applicable for financial liability. Equity is not remeasured. If the instrument has an option to convert into share, if any problem contains an option to convert into share, then it means it is a hybrid instrument. Case 1. See what kind of question can be asked. If the principal amount is payable on maturity in cash and coupons are paid periodically, so there is only coupon payment and principal payment, but principal is paid in cash on maturity, then it is a pure financial liability. If coupons are paid periodically and principal is redeemed by issue of fixed number of equity share, as we have studied today, fixed number of equity share means equity component, then the interest portion is liability and the redemption portion, which is in fixed number of equity share, is equity. Therefore, a combination of liability and equity is a compound financial instrument. Case number 3. If coupons are paid periodically, this portion will be liability, and there is an option to redeem in cash or fixed number of share, and there is an option also to redeem in cash or fixed number of share. So if the holder decides to get cash, company has no option but to pay him cash, or there can be a fixed number of equity share to be issued, or the holder may demand a fixed number of equity share to be issued. Then such instrument is called CFI, compound financial instrument, because there is an option to issue fixed number of equity share. So when there is an option embedded in the instrument under which fixed number of equity share will be issued, that portion becomes a compound financial instrument. So what we have to do, because now it is a hybrid instrument, a compound instrument, I have to split the liability portion and the equity portion, because the accounting treatment of liability portion is different from the accounting treatment of equity portion. So we'll have to now identify how much is the liability component and how much is the equity component. To find out the liability component, I have to check what is the contractual obligation to pay cash. What is that amount of cash which we cannot avoid? Second, what is the contractual obligation to pay variable number of own share, variable. This portion is financial liability. And what is the contractual obligation which cannot be avoided? So this portion is financial liability component. Then identify the discount rate to be used in split accounting. Because the cash flows will take place in future period, I need to find out the present value to find out the liability portion. So what I'll do, I will see what is the market rate for similar instrument, that rate will be used, which can be MIBOR, LIBOR or any such rate. The present value of the future cash flow is financial liability. Then what is equity? As you have studied, equity is the residual interest. So from the proceeds, but without transaction cost, very important, transaction cost I will tell you separately. I will not deduct transaction cost here, because if I deduct here, the entire transaction cost gets allocated only to the equity part, only one instrument, but transaction cost needs to be apportioned. So I will take only proceed without transaction cost minus financial liability we have computed in the step 4, and that is equity. So in the exam, two type of questions are asked. One is with transaction cost, one is without transaction cost. If it is without transaction cost, then it is very easy. We have got equity portion and liability portion. But if there is a transaction cost, if there is transaction cost for issue of this instrument, then it will be allocated to financial liability and equity. So what will be the ratio? For financial liability, this is the ratio. For equity, this is the ratio. So for example, this may be 9 lakh, this may be 1 lakh. So if there is any transaction cost, it will be allocated in the ratio of 9:1. So we will deduct the transaction cost from liability and equity. So my financial liability will become the amount calculated in the step 4, which was present value of future cash flow, minus transaction cost allocated. Now there will be a problem. What is the problem? The financial liability you have computed in step 4, that figure will change. That figure will change because you have deducted transaction cost. So what you will have to do? In such case, you will have to recalculate IRR. You have to recalculate IRR based on revised value of financial liability. So this is very, very important. Many times the student forget to recalculate IRR in case of compound instrument where you have transaction cost. So accounting treatment now, initial recognition, bank account debit, proceed less transaction cost, because you will receive net amount, to financial liability as we have computed in step 7, and to equity, that means step 5 amount minus allocation of transaction cost. So this will be my initial entry. Equity will be reported in SOI. Equity will be reported as SOI, as in SOCIE as component of equity. What about subsequent accounting? If financial liability is amortized cost instrument, its fair value will not change. And as you know, equity is not fair valued again after initial recognition. Then as usual, we will record the borrowing cost account debit based on effective interest to bank account, the payment made, and to financial liability will adjust the balancing figure. Some students prefer to pass two entries. So you can pass two entries separately also. First entry you can pass borrowing cost to financial liability, that is calculated based on effective interest rate, and whatever payment you will make, you will pass the entry financial liability account debit to bank. Whatever borrowing cost you have incurred here, this figure will go to P&L account as an expense unless capitalized under Ind AS 23. Student make a mistake. The payment that they are making, that they transfer to P&L account. No, that was CA intermediate, that was foundation 12th standard. In final, you have become a bigger entity now. You are a more learned person now. Now see the presentation in the balance sheet. Non-current liability, financial liability, borrowing, that component of borrowing which is due after 12 months will come under non-current liability, and that portion which will be due within 12 months will be treated as current liabilities. Let us come to the settlement date. Conversion into equity share. Suppose the instrument requires mandatory conversion into equity share. Fixed number of equity share have to be issued. Equity account debit which you had credited earlier, and from that equity account you credit share capital and credit securities premium. If variable number of shares have to be issued, that means the instrument was earlier treated as financial liability, because variable number of shares to be issued means the instrument is a financial liability. So financial liability account debit to share capital and excess amount to securities premium. That was mandatory conversion. Now optional conversion. Suppose we settle the financial liability by paying cash. Suppose the holder wants cash, financial liability to bank. Suppose the holder wants shares. Or we issue shares, then the liability account debit to share capital to securities premium, and whatever is the balance left in equity account, that we will transfer to securities premium account. Although the standard does not tell you which account you will credit to, but normally we will transfer to securities premium, or we can transfer to any other reserve also if there is any balance in equity account. Okay. If deferred tax is to be calculated, because Income Tax Act does not deal with compound instrument, they still follow the old method of accounting. So there will be a difference between the book value and the tax base. So that will be covered by Ind AS 12. We will discuss separately. Any interest paid will be transferred to P&L account unless it can be capitalized. And how do you compute the interest here? Under amortized cost, take the opening balance of financial liability and multiplied by IRR. Now we'll discuss the last part of the standard. Early redemption of financial liability. Early redemption of financial liability. So usually the company may ask the holder that we want to redeem the financial liability before the due date. Okay. Now the question is, if it is a compound instrument, where the company decided to redeem it before the due date, how much amount will be adjusted in P&L account and how much amount will be adjusted in equity? Let us see. So difference between carrying amount, suppose this is carrying amount of financial liability 1 lakh, and suppose the amount paid to settle is 1,15,000. The company says take 1,15,000 and let us close our liability. So what is the difference? The difference is 15,000. How that 15,000 will be treated? So first is difference in the carrying amount. This is my carrying amount of financial liability. and revised carrying amount based on balance cash flow and revised discount rate. So I will calculate the value of liability again by calculating present value of remaining cash flow using the discount rate which is available on the date of early redemption. I will recalculate the value of liability using the revised discount rate which is available on the date of redemption. Suppose this revised liability comes to 1,05,000. Based on revised discount rate, my liability comes to 1,05,000. So this difference of 5,000, what will I do? This difference of 5,000 is the gain or loss on remeasurement of liability, and it will be transferred to P&L account. It will be transferred to P&L account. But what about this difference, 1,05,000 and 1,15,000? Difference in the revised carrying amount means 1,05,000 on balance cash flow and revised discount rate versus the amount paid 1,15,000. Difference between the revised value of liability and the amount paid, it is called gain or loss on settlement, and it will be adjusted within equity. Sir, why it is adjusted within equity? If I adjust it within P&L account, it will amount to remeasuring equity, and remeasurement of equity is not allowed. Okay, that is why the difference between the revised carrying amount of liability and the amount paid will be treated as adjustment in equity. Whatever is the balance left in equity, now any balance left in equity account will be transferred to other component of equity. Balance left in equity account will be transferred to other component of equity. Next is accounting mismatch. Accounting mismatch means you have financial asset, you have financial liability. Suppose there is a company called Silicon Valley. There is a company called Silicon Valley. It has financial asset which are suppose based on floating rate, and it has financial liability where the interest rate is fixed. So there is an accounting mismatch. There is an accounting mismatch. There is an asset liability mismatch. There is an asset liability mismatch. If they follow amortized cost for this, if they follow amortized cost for financial liability, if they follow amortized cost for financial liability, then the fair value of the liability will never go to P&L account, but change in fair value of the asset will go to P&L account. So P&L account will fluctuate. What the standard says, to protect your P&L account, this financial liability, instead of classifying as amortized cost, you classify it as FVTPL, so that gain or loss on both the liability and the asset will hit the P&L account. Loss in one will be compensated by the gain in another. And in that case, a financial liability, in order to correct the accounting mismatch, can be classified as FVTPL. Suppose you are adopting Ind AS for the first time. Ind AS for the first time, Ind AS 101 is applicable, and the problem will arise in case of compound financial instrument, because under old accounting standard there was no concept of compound financial instrument or split accounting, but under Ind AS If there is a compound financial instrument, then you have to separate the liability portion and the equity portion. So what I'll do, first I'll find out what is the liability portion based on contractual cash flow. Whatever contractual cash flow is there, I will find out that. I will choose an appropriate discount rate on the date of transition. So contractual cash flow which is remaining versus the discount rate, and I will be able to find out what will be the liability component of that compound financial instrument. So I got the liability component of compound financial instrument, but that instrument already has some book value. So old liability will be cancelled. Old liability debit to new liability as per Ind AS 32 will be recorded, and if there is any difference between the two, then it will be adjusted in retained earning. So this is the treatment on the date of transition, that is when the entity applies Ind AS for the first time. What will you do with the compound financial instrument? So dear student, we have prepared one book called Compiler. What is Compiler? It contains question answer of all Ind AS taken from study material, RTP, MTP, past exam, and some other good reference books also. So in one place, chapter wise, you will get all questions asked by the institute. So this will help you in your preparation for your exam. This can be used by CA student also, CMA student also, and those who are preparing for IFRS exam, they can also use it. This is called Compiler. Then there is another very good book I have prepared, which is called Financial Reporting Class Note with Solution. This is one of the most amazing books that I have ever prepared. It contains question, answer and theory both in one book only. Compact will have only theory, Compiler will have only question, and this Class Note with Solution have theory plus question. The answers are presented in exactly the same way we have taken in the classroom. In fact, we have taken the notebook of a student and we got it converted into a book so that large number of students can benefit from this Class Note with Solution. One-stop solution for your FR requirement. You don't need to refer any other book. You don't need to buy any book. If you have taken video lecture and if you find it too lengthy, then this notes cover answers also. It has taken almost 2 years to prepare this very high quality notes, where we have also covered the answer as dictated in our classes. So we have Class Note with Solution, we have Compiler, we have Compact, FR Summary Chart. These books you can purchase from our website vino.in. Right now we are offering this book at 30% discount. You can also purchase from our web office located at Prestige Point, first floor, Pune. Student of Pune can come and purchase from our office also. They can have a look at it. If you want some sample pages, you can ask our office staff and they will provide some sample pages also. So you can email us on email ID any information that you need. If you want to purchase any book, video lecture, we have video lecture of other faculties also at a highly discounted price. So email is asfoundation1@gmail.com. You can call us. Our number is 97669-21860, or you can call us at 9667-671155. This is our WhatsApp number also. So I would request you to join our WhatsApp group, join our Telegram channel, Instagram, YouTube channel, and we will try to provide you maximum help that we can. So with this, thank you very much for watching this video. Please share with your friend also. I hope you liked it. Thank you very much. Good evening, friends. Today we are going to take a very important standard, Ind AS 109. Ind AS 109 is called financial instrument, and as you know, you will get a question on this standard definitely. It is believed that this is a difficult standard, but actually it is not the case. If taught properly and if learned properly, then you can make it a scoring topic. Today is the super fast revision of financial instrument. We will not be taking numerical questions, but we are going to cover all important concepts. In fact, all concepts we will cover which are highly tested in the exam. I will also give you the journal entries to be passed for different situations. So this will be very useful to you. One day before the exam, you can just watch this video and this Ind AS 109 will be completely clear. Ind AS 32 we have already covered. So now we'll take this standard Ind AS 109. So please pay attention. First we'll see what is the guidance covered by Ind AS 109. So Ind AS 109 covers recognition principle, derecognition principle, classification principle, measurement of financial instrument, impairment, and the last part is called hedge accounting. So this is our topic that we have to cover in Ind AS 109. So first question is, when should financial asset be recognized? When should I bring financial asset in my book? Financial asset will be recognized in the books only and only when the entity becomes party to the contractual provision of the instrument. So that means the entity becomes a party to the contractual provision. So it is having rights and obligation under the contractual provision of the agreement, and on that date that financial asset would be recognized. In this chapter we are going to talk more about financial asset. Financial liabilities we have covered in Ind AS 32 in detail. If you have not seen the video, you can watch the video on the YouTube channel AS Foundation Financial Liability. So before I proceed further, I just need to inform you for the benefit of a large number of students that we at AS Foundation, we have an app called Vino. In this Vino app, for limited period we are having a scheme called 1 rupee loot. You can download the app and you can get this books for just 1 rupee. You can watch the books in your app itself. So the books available are FR books, class note, summary chart, quick revision, compact, SFM practice booklet, summary book, formula book, FSCM book, case study digest, similarly risk management and GFRS book and case study digest. You can also view these books on your Apple phones, Apple devices also. For Apple users, download Class Plus app and use the code KWUDA, that is our educational institution code for this Class Plus app, and you will be able to access the video. So now we are also available on iPhone or iPad. You can watch our video lectures, you can watch our books, you can read our books on iPhone or iPad and Apple devices also, but you just have to download Class Plus app and put the code KWUDA and you are ready to go. So download now today this app. If you are Android user, just go to the App Store and write Vino, that is enough. So we'll see now classification of financial asset. Classification of financial asset would be cash, very easy, no special accounting required. Derivative, usually at FVTPL. Investment in equity instrument, we'll see in detail. And other financial assets like receivable, advances, loan, investment in debt, and investment in preference shares. So first quickly I will tell you about derivative. We will discuss about derivative in detail subsequently also. Derivatives are always measured at FVTPL. FVTPL means fair value through profit and loss account. I am not talking about cash because cash you don't require any special accounting. Investment in equity instrument, the standard says it will be FVTPL. Investment in equity instrument will be at FVTPL, but there is some exception. In those exceptional cases, investment in equity instrument can be classified as FVT OCI also, fair value through other comprehensive income, and we are going to cover equity instrument in detail after some time. And what about other financial asset? So derivative always FVTPL, equity instrument usually FVTPL, but in some exception cases FVT OCI. What about other financial asset? So as per Ind AS 109, other financial asset will be divided into three types. One is called amortized cost category. Second is called fair value through other comprehensive income. Third is called fair value through profit and loss account. A financial asset will be categorized as amortized cost category if it passes business model test 1 and contractual cash flow test. It will be classified as FVT OCI if it passes business model test 2 and contractual cash flow test. If it does not fit into these two category, then automatically it will get categorized as FVTPL. And in case of accounting mismatch also, which I had covered in Ind AS 32, it will be treated as FVTPL. So now the student will ask, what is business model test 1, business model test 2 and contractual cash flow test? So let us understand, when are other financial asset categorized as amortized cost, FVT, OCI or FVTPL? So condition for classification of financial asset. So we have to perform two tests to check the classification, whether it will go to amortized cost or FVT OCI, and these tests are called business model test and contractual cash flow test. Remember, this is a super fast revision, so therefore I am expecting you have read this standard once, and today we have come here for revision purpose only, so that the whole chapter goes before your eyes in just 1 hour. So first we will see business model test. What is business model test? That means what is the policy of the company with respect to that financial asset? What is the objective of holding the financial asset? So there are two possible objectives. One is called BMT1, business model test 1. Here the objective is to obtain contractual cash flow from financial asset on the specified due dates. That means whatever interest plus principal which have been agreed upon, the objective is to collect it on those days. The objective is to receive all cash flows by holding it, not by selling it. That means you want to just hold it till maturity and get all the promised cash flow. The cash flow will be in the form of interest and principal. The second objective of holding financial asset can be to obtain contractual cash flow and by selling it also. That means you are keeping both the option open. You want to hold it also, and if need arises, if you want, you can sell it also. So there is no requirement to hold it till maturity. So if that is the objective, then we will call BMT2, Business Model Test 2. And then the next test is called Contractual Cash Flow Test. So BMT1 plus CCFT will be amortized cost. BMT2 plus CCFT will be FVT OCI. So what is common in both? What is common in both? The common part in both is CCFT. Okay. So contractual cash flow test, under this test financial asset is analyzed to identify contractual cash flow. If financial asset is capable of generating cash flow which is solely due to principal and interest on specified period, the contractual cash flow will cover only the principal and the interest on the specified date, then we will say contractual cash flow test is satisfied. So principal and interest are generated from that financial asset on specified dates, then we will say contractual cash flow test has been passed. In case of equity share, this test will not pass because there is no contractual cash flow. In case of derivative, this test will not pass because there is no contractual cash flow. But in case of debenture and bond, this test can be passed because they generate contractual cash flow in the form of interest and principal. It means financial assets should generate only principal and interest and on the specified date. So I am going to tell you that only debt instruments are capable of meeting the contractual cash flow test, like investment in debenture, investment in bond. Derivative asset and investment in equity instrument will not be able to meet the contractual cash flow test because there is no contractual cash flow and there is no specified date also. Now next issue is measurement of financial asset and accounting treatment. So now we are entering into the main part of the standard. Up to this there was some basic discussion. Dear student, if you want to get this presentation, we have a book called FR Compact book. This FR Compact book contains the entire FR notes in simple language. The way it is appearing on the screen, it is written in the same way. You can purchase it from our website vino.in. You can revise your entire FR in just few hours, 2-3 hours. You can go through it. It is presented in a very simple manner and you can easily read it. Readable font, student handwriting format. So I will highly recommend that you purchase this FR Compact book. This contains only theory. If you want to practice more questions, numerical question, you can purchase FR Compiler. It contains question from RTP, MTP, study material and past exam. And if you want to get summary book, chart book, so this is a chart book, summary chart book, where the all standard applicable in your syllabus is presented in the chart form. So FR summary chart you can purchase from website vino.in. And one more book about which I will tell you later. So continue. Compact book, compiler book, summary chart you can purchase from website. Very useful book. You will not find such books in the market. It's only available on our website vino.in. The student will now come to the discussion on the screen, measurement of financial asset and accounting treatment. So I will divide financial asset into two categories for accounting purpose. One is short-term financial asset whose realization is within 12 months from the reporting date. And this discussion is not applicable for the following three items: cash, derivative, and investment in equity instrument. We will discuss derivative and investment in equity instrument separately. Special treatment for derivative and equity instrument. It will cover short-term bond, short-term debenture, receivable, loans which have a maturity of less than 12 months. So what is the accounting of short-term financial asset? There are three categories possible that we have discussed already: amortized cost, FVT OCI, FVTPL. If it is amortized cost category, when it is amortized cost category, when business model test 1 plus CCFT is passed, then we will call it amortized cost. On the date of purchase, initial recognition entry will be financial asset account debit to bank account, being financial asset recorded, and the amount will be equal to amount paid plus any transaction cost minus any processing fees received. Then if it is a debtor, a debtor or receivable, then the entry will be financial asset account debit to sales account, and the transaction price will be as per Ind AS 115. If it is FVT OCI instrument, same like amortized cost. If it is FVTPL instrument, in FVTPL instrument, the transaction cost is not capitalized. The transaction cost is separately charged to P&L account. Very important, it will come everywhere. So amount paid for financial asset account debit to bank, amount paid minus processing fees received, transaction cost account debit to bank, and transaction cost is transferred to profit and loss account. If fair value based on transaction is different from fair value as per level 1 input, that fair value as per level 1 input is covered by Ind AS 113. So if there is a difference, that difference will be adjusted in P&L account if the instrument is FVTPL, and OCI if the instrument is FVT OCI. Now we'll come to year end. Short-term financial asset accounting at year end. If it is amortized cost instrument, interest will not be recorded because short term. No adjustment for change in fair value. In amortized cost category, no adjustment is made for change in fair value. Remember, an FVT OCI, interest will not be recorded. But if there is any change in fair value, that change in fair value will be recorded in OCI. The OCI reserve can be recycled. OCI reserve can be recycled when the instrument is derecognized. About that we'll discuss later. At the end of the year, fair value will be calculated without transaction cost. At the beginning I had told you, at initial recognition we take transaction cost also, but at the end of the year, the fair value will be without considering the transaction cost. And now FVTPL at year end, interest will not be recorded because it's a short term instrument, but if there is a change in fair value, it will be routed through P&L account. At the end of the year, fair value will be calculated without considering transaction cost. Now short-term financial asset on settlement, that means when we are going to settle it, and if it is an amortized cost instrument, you will receive the amount on settlement bank account debit to financial asset. If there is any difference between book value and the consideration, you will transfer it to profit and loss account. If it is FVTOCI instrument, bank to financial asset, difference will be transferred to OCI reserve and OCI reserve will be recycled to profit and loss account. If it is FVTPL instrument, bank to financial asset, and difference will be recognized in profit and loss account. So this was about short term financial asset. We have seen accounting initially, at year end, and on settlement. You can watch this video again and again and you will understand. So I'll request you to watch this video one or two more times and all your concepts will be cleared. Now I was telling you we have one more book, fourth book, called the best book in financial reporting available in the country, and this is called Financial Reporting Class Note with Solution. You can see this book on the screen. So the important thing about this book is that it contains theory as well as the question and answer. The answers are presented in a very simple way, the way we dictate the answer in the classroom, plus tutorial notes are written at the end of the answer. So if you have doubt, you can read the tutorial note. If there is a mistake in the question, we have pointed out that also and why there is a mistake in the question. At some places we have given alternative answer also. So basically it will cover ICI, study material question, RTP, MTP, past exam question. At one place you will get everything arranged chapter wise. Within chapter also the questions are arranged concept wise. So honestly speaking, this is the best book on financial reporting available throughout the country. If you check it, only then you will realize how wonderfully it has been presented. So you can purchase this financial reporting class note with solution book from our website vino.in. Now we'll come to long-term financial asset. Long-term financial asset other than cash, other than derivative, other than investment in equity instrument, because derivative and equity instrument will be covered separately. So here also we will discuss three financial asset: amortized cost, FVTOCI and FVTPL. So we are now discussing long-term financial asset, amortized cost category, initial recognition. Same like what we have discussed in short term. Financial asset account debit to bank account, the amount is equal to amount paid plus transaction cost minus processing fees received. But because it is a long term financial instrument, we are going to calculate effective interest rate or EIR, because the interest will be recognized based on effective interest rate, and for that we will prepare one amortization schedule which will have opening balance, interest, cash flow and closing balance. So this is called amortization schedule, and the interest will be calculated here as per EIR, and contractual cash flow we will write as per the contractual arrangement. After the life is over, if it is a 5-year bond, then after 5th year the balance should become 0. So this is right now amortized cost. At the year end, what I will do, financial income will be recognized using effective interest rate method. If it is amortized cost instrument, don't change fair value. Don't change fair value. However, valuation allowance can be made, means impairment or provision for doubtful debt, what they call it. The provision for doubtful debt can be made. What about the accounting and discalculation? to be discussed after some time. Now we'll come to settlement. On settlement, the entries as usual: bank account debit to financial asset. Any difference will be transferred to profit and loss account. Long-term financial asset, which is FVT OCI category, on day 1 initial recognition, same as amortized cost. Here also we will calculate effective interest rate. Here also we will prepare amortization schedule. At the end of the year, we are going to calculate or find out fair value as per Ind AS 113. So FVT OCI instrument, we are going to recognize finance income as per effective interest method based on the amortization schedule that you have prepared. And fair value at the end of the year, fair value at the year end will be without transaction cost. Any difference between carrying amount and fair value will be transferred to OCI reserve. OCI reserve will be later on recycled to profit and loss account. And now we'll come to settlement. That is when the financial asset is to be derecognized. It is settled as usual. Entries bank to financial asset. Any difference will be first transferred to OCI reserve. From OCI reserve, it will be recycled to profit and loss account. Now we'll come to FVTPL instrument. Long-term financial asset classified as FVTPL. Initial recognition entry will be at only fair value. Transaction cost will be recognized in P&L account. Very important. In FVTPL, transaction cost is recognized in P&L account. In FVTPL, we do not calculate effective interest rate. We do not calculate IRR in FVTPL. So journal entry will be on initial recognition, financial asset account debit to bank account, transaction cost account debit to bank account, and transaction cost will be transferred to profit and loss account. At the end of the year, fair value is calculated as per Ind AS 113. Finance income is not recognized. Finance income is not recognized. Any difference between carrying amount and fair value, difference between carrying amount and fair value is transferred to P&L account. And on settlement of the financial asset, bank to financial asset, any difference is recognized in profit and loss account. So what we have covered till now, understand. First we have covered short-term financial asset. Then we have covered long-term financial asset. 3 categories we have discussed: amortized cost, FVT OCI, FVTPL. Now we are going to cover investment in equity instrument. Investment in equity instrument, that is investment in shares. Regular way of purchase. First we will cover regular way of purchase and then we will cover other way of purchase. Regular way of purchase means they are purchased in an organized market. So what the standard says, investment in equity instrument will always be classified as FVTPL, but there are some exception. Under that we can classify it as FVT OCI. Regular way of purchase means they are purchased in regulated market or conventional market like Bombay Stock Exchange or National Stock Exchange, which is regulated, which is a conventional market. There are market timings, there are days when it is traded, there are procedure by which you buy or sell shares. First thing, remember, usually they are FVTPL, but company can designate entity can designate it as FVT OCI, but that is an irrevocable choice. Once you classify it as FVT OCI, once an equity instrument is classified as FVT OCI, later on you cannot classify it as FVTPL. Okay, so make this choice carefully, because this cannot be reclassified later. So it is like your CA course. Make the choice carefully. Later on, very difficult to reverse the decision. Okay. So usually if the financial asset is held for very long term, if it is for strategic reason, then the company call it as FVT OCI, because they don't want to hit their P&L account every year. In any case, they are not going to sell it. Now next is, if equity instrument is held for trading or speculation. If the objective is trading, that means buying with the objective of selling immediately and making profit, or for speculation, then you cannot classify it as FVT OCI. Such instruments are always classified as FVTPL. But if the investment is for long-term strategic purpose, it will be FVT OCI. If it is FVT OCI, the change in fair value is also recognized in OCI, and subsequently it is not recycled. Very important, if the instrument is equity instrument classified as FVT OCI, subsequently the balance in OCI will not be recycled to P&L account, but it will be recycled to any other component of equity. So within the reserve it can be transferred. If equity instrument is held for trading or speculation, always FVTPL, change in fair value in P&L account, and there is no choice. To classify it as FVT OCI. So instrument held for trading or speculation will always be FVTPL. So this was our discussion on equity instrument acquired in regular way of purchase. Then investment in other equity instrument, that is which are not traded in the organized or conventional market. Like you can acquire shares of some private company, where there is no regulated or organized or conventional market. So what is the treatment for such other equity instrument? First of all, there is no major difference in the accounting. This will also be classified as FVTPL. Initially, it will be recognized at the amount paid, that is fair value. Transaction cost will be charged to P&L account. Any change in fair value will be transferred to P&L account. If the equity instruments are not purchased in regulated market, then it is accounted as follows. On trade date, it is treated as derivative. On trade date means the date you commit to buy or sell. So this is applicable for those equity instruments which are not purchased in regulated market. On a trade date, it will be treated as derivative. That means any change in fair value will go to P&L account, and till settlement date, that is the date when you actually take the delivery and make the payment, it's called settlement date. Delivery and cash are done on this date. Till that date, it will be treated as derivative, and it will be any change in fair values transferred to P&L account. On settlement date following, journal entry will be passed. Investment in equity account debit to bank account, being investment purchased. Such instruments are always classified as FVTPL unless otherwise mentioned. Any transaction cost paid will be written off in profit and loss account. At the year end, any change in fair value will be recognized in profit and loss account on the sale of the instrument, bank to investment in equity instrument, and any difference will be transferred to profit and loss account. So that was the accounting treatment for other equity instrument which are not purchased by regular way of trade. Now we'll come to accounting for purchase in case of regular way of trade. Are you enjoying or not? First tell me that. If yes, then say yes, we are enjoying. So what is regular way of trade? That is, they are traded in regulated or conventional market like stock exchange, where we have timing of trading. There are settlement period. T+2 cycle is followed. Market opens at 9:15, market closes at 3:30. So in case of regular way of trade, we have two choices to do accounting. Equity instrument purchased in case of regular way of trade, two choices you have. One is called trade date accounting and one is called settlement date accounting. This option is available each year, but whatever accounting policy you choose, you will apply that for all such equity instrument throughout the year, and it will be disclosed in the note. This option should be applied to all investment purchased in the regulated market in that year. So 1 year you can follow trade date accounting for all the investment. Another year you can follow settlement date accounting for all such equity instrument. Now for the simplicity, we have to divide into 3 columns. Accounting for purchase in case of regular way of trade. Now even a debt instrument can be purchased in regular way of trade. Then it can be classified as amortized cost, or any debt or equity instrument can be classified as FVT OCI or FVT PL. So we will discuss our accounting in case of regular way of trade in 3 columns. If it is amortized cost, if it is FVT OCI, or if it is FVT PL. Student will pay attention on the purchase of investment, and we are following trade date accounting. In trade date accounting, investment is brought into the books on trade date itself. That is the date when we enter into a contract. Like in BSc, if you enter into a contract on Monday, the delivery takes place on Wednesday. So Monday will be the trade date, Wednesday would be settlement date when the shares actually reach your Demat account. So entry will be amortized cost. First column amortized cost, second column FVT OCI, third column FVT PL. Financial asset account debit to broker account, and the amount is equal to amount paid plus transaction cost. FVT OCI same, financial asset to broker account, the amount is equal to amount paid plus transaction cost. But if it is FVT PL, financial asset account debit, transaction cost will be debited separately, because I am not going to add it to the initial value of financial asset to broker account being investment purchased. So very important, the third column FVTPL. Now we'll come to year end. First column is amortized cost. There is a change in fair value, but if it is an amortized cost instrument, then we are not going to record change in fair value. But if it is FVT OCI instrument, then entry will be either financial asset to OCI reserve if fair value goes up, or OCI reserve to financial asset if fair value goes down. And same thing for FVTPL instrument also. Transaction cost will be first transferred to P&L account. transaction cost will be transferred to P&L account, and change in fair value of financial asset will be transferred to P&L account. Now next is on settlement date. On settlement date, in all the three cases, the entry will be broker account debit to bank account being amount paid. Then on settlement date, if there is a change in fair value, on settlement date, if there is a change in fair value and if the instrument is amortized cost, no entry for change in fair value because first column is amortized cost. If it is FVT OCI instrument, then on settlement date we'll pass entry for change in fair value, financial asset account debit to OCI account if fair value goes up, or OCI account debit to financial asset if fair value goes down. And third column, the last column, is FVTPL column. If there is a change in fair value on the settlement date, we'll pass the entry financial asset to P&L account for value. If it is going up, financial asset to P&L account. If the value goes down, then P&L account debit to financial asset account. That was about trade date accounting. Now we'll come to settlement date accounting. This is little complicated because here we are not going to recognize the financial asset on the trade date in the books, but we are going to recognize it on the settlement date. So here also I will divide into three columns. First is amortized cost. On trade date, we will not pass any entry because we will recognize financial asset on settlement date. No entry in FVT OCI also, and no entry in FVTPL also. Now we'll come to year end. At year end, suppose there is a change in fair value. At year end, suppose there is a change in fair value. In amortized cost category, again no entry, no treatment. But if it is FVT OCI instrument and there is a change in fair value, we will open an account called fair value adjustment account, because financial asset is not there in my books right now. So temporarily we will open an account called fair value adjustment account to OCI reserve account. And if it is FVTPL instrument, we will pass an entry fair value adjustment account to P&L account if the value of the investment goes up. If the value of the investment goes down, we will reverse the entry. If the value of the asset goes down, in the second and third category, we will reverse the entry OCI reserve to fair value adjustment. Here P&L account to fair value adjustment. Next is settlement date. On settlement date, amortized cost category, entry will be financial asset account debit to bank, amount paid plus transaction cost. But if it is FVT OCI instrument, then financial asset account debit. Remember, we have created one account called fair value adjustment account. To fair value adjustment account, that fair value adjustment account will close. Financial asset will be recorded at fair value. Any payment made to bank account and to OCI reserve balancing figure. And if it is a FVTPL instrument, then financial asset account debit at fair value to fair value adjustment account to bank account, and any difference on settlement date, the balancing figure will be transferred to profit and loss account. Now we'll have one important discussion which usually they don't cover in the study material properly or in the notes, is investment in bonds in foreign currency. What is the issue involved? The issue involved is two standards will become applicable here. One is Ind AS 109, because it is investment in bond, so it will be categorized as either amortized cost or FVTOCI or FVTPL. So whatever we have learnt will be applicable, but it is also a bond in foreign currency. So Ind AS 21 will also apply because it's a monetary item, and therefore we will have to revalue the investment using the closing exchange rate. So the question is, how much difference will go to the P&L account under Ind AS 21 as exchange difference, and how much difference will be recognized as per Ind AS 109. So let us see, very important tick mark. If they ask you a question on this, you have to be prepared in advance, otherwise you will not be able to solve it. Okay, many students are not able to understand this. What is this question? Such bonds can be foreign currency convertible bond or any bond in foreign exchange. If these investments are recorded at FVTPL or FVTOCI, so here we have one more challenge. We will have to measure the fair value. Then closing balance of the bond will be at fair value in foreign currency. So first calculate fair value in foreign currency and then you convert into presentation currency by applying the closing rate. So in case of FVTPL or FVTOCI foreign currency bond, fair value will be calculated in foreign currency first, then multiplied by closing rate to convert into presentation currency. Then you calculate the closing balance at book value using closing date exchange rate. Closing balance at book value using closing date exchange rate. Difference is transferred to exchange difference. Difference transferred to exchange difference to be transferred to P&L account. So the difference between book value and value based on closing rate will be transferred to P&L account. Step number 2, then this instrument will be measured at fair value. Here we are only transferring the book value and the closing balance based on closing rate to P&L account. Here in step 2, we are calculating the fair value of that bond first in foreign currency, convert it into closing exchange rate, and this difference will be recognized either in OCI or P&L account, will depend on the category of the investment. If the category of the investment is FVTOCI, then the fair value change will be transferred to OCI. If the instrument is FVTPL, then that fair value change will also be transferred to profit and loss account. So two differences will arise here. One difference is because of exchange difference under Ind AS 21, and the other difference is due to change in fair value. The exchange difference part will always go to profit and loss account. The fair value part will go to OCI or P&L account depending on classification. In our notes, we have a question on this where we have solved a problem by using all three categories, and that will help you to understand. Right now we will not be able to take the numerical question. It will take a lot of time, but requesting you to read from our class notebook or our compiler, you will find that question. Now the next part is special cases of advances which are at off market terms. That means which are not at normal commercial terms. And what are the questions they usually ask? This is a highly tested area in the exam, staff advance. Another area which they will test in the coming exam is security deposit. Third is loan between parent and subsidiary, which is either without interest or at a lower interest, and other loans which are at off market terms. So first today we'll see staff advances. A company gives loan or advance to the staff either at zero interest or at a very low rate of interest. Somewhere in that there is a employee compensation cost involved. So first we will find out the fair value of the advance using market rate of interest for similar loan. Fair value is equal to contractual cash flow into market rate expected. So suppose this comes to 8 lakh rupees, fair value comes to 8 lakh, and then we'll see how much was the loan actually paid, 10 lakh minus any fair value 8 lakh. The difference will be treated as staff cost. The difference will be treated as staff cost. If the amount given as advance to staff is more than the fair value or the present value using market rate, the difference is treated as staff cost. The staff cost, what is the further treatment of that? Any excess amount paid will be transferred to P&L account if service condition does not exist. If there is no service condition, employee is not required to complete any service condition, then in that case you transfer it to P&L account. But if there is a service condition, then it will be treated as a prepaid staff advance. If there is any service condition like he has to complete 3 year or 6 year, it will be treated as a prepaid staff advance and it will be written off, amortized over the service condition in SLM method. So the entry will be employee benefit expense account debit to prepaid staff advance account. Every year you will have to write off that prepaid staff advance. Now the student has a query here, what are we supposed to assume? Because the institute does not mention whether service condition exists or not. So whatever you want to do, then you have to write an assumption. If time permits, then you can write both the answers. But I am sure you won't have time. So it is better to write a note and solve the problem. Sometime employee contractual cash flow may be realized by way of adjustment in salary package. So instead of employee repaying you the loan in cash, it may be adjusted against the salary payable, no problem. Some exam question have this adjustment. Employee prepays the loan or makes part repayment of the loan. The loan was given to employee for 10 years, but he may come after 6 years and he may repay some portion of the loan in advance. So what will I do? I will calculate new fair value. I have to again compute fair value based on remaining future cash flow multiplied by original market rate of interest. So I will recalculate the fair value now. I will compare with book value, calculate book value of staff advance and prepaid staff advance on the date of prepayment. Find out the book value of staff advance and prepayment of staff advance, if any. The difference between book value, which is there in the ledger, fair value which we have computed based on revised cash flow, will be either adjusted in P&L account, if no service condition exists, or will be adjusted in prepaid staff advance account if service condition exists. So this portion is very important. Please watch it again in your free time and a day before the exam. Amortization of staff advance will be on prospective basis. So whatever balance remains in the prepaid staff advance account, that will be adjusted prospectively. Another area is security deposit given in business under off market terms. Usually you will find, let us say you have taken a premise on lease, so you are required to give security deposit which will be refunded to you, let us say after 5 years once the lease period is over, and usually either it is interest free or very low interest is paid on that security deposit. So the standard is very smart. It says the amount of security deposit given and the fair value of the cash flow you are going to receive are not the same. So there is some other item involved in that security deposit. There is a difference between fair value and the amount given as security deposit, and that will be treated as per this standard. So sometime in business operation, entity is required to deposit security to any other entity for smooth access to business operation, and usually it is on off market terms. So first we will see if it is on market terms. On market terms means as per the market, no hidden amount or value included in that. So in that case there is no special treatment. You will pass an entry security deposit account debit to bank, amount paid plus transaction cost. But institute will not give you on market terms. They have to extract money from you, so they will give you question which will have off market terms, which means first you will have to compute fair value of the security deposit using market rate of interest and agreed contractual cash flow. Then find out the excess payment. The amount paid plus transaction cost is what you have given, let us say 10 lakh, and the fair value, let us say 8 lakh, present value of contractual cash flow at market rate. The difference excess is 2 lakh. So either it will be recognized in P&L account or it may be amortized over the period, depending upon what is that item. Excess paid will be treated as prepaid asset in non-current asset, other non-current asset, which will be amortized over the period of the contract. So journal entry now will be, in future, first security deposit account debit. So you will pass an entry security deposit account 8 lakh, prepaid asset account debit 2 lakh initially, and to bank account 10 lakh. Then every year you are going to amortize that prepaid asset expense account debit to prepaid asset account, and this will be transferred to profit and loss account, and security deposit will be unwound. So every year I have to calculate finance income on the opening balance, and I will pass an entry finance security deposit account debit to finance income, and finance income will be transferred to profit and loss account. It is called unwinding of discount. And finally on maturity, security deposit account will be realized, and you will pass an entry bank account debit to security deposit account, being amount realized. Now I will tell you one more question which they have asked more than once in the exam is intercorporate loans in groups. Holding company may give loan to subsidiary. subsidiary company can give loan to holding company, and usually it may be given either interest free or they may charge a very low rate of interest. So first we will take an example where parent has given loan to subsidiary. Okay, so it requires some special treatment if it is not at market terms, because somewhere some other consideration is also involved. So first we will see short term loan repayable on demand. Again we'll divide into two types, short term and long term. Short term loan repayable on demand. Short term loan repayable on demand, it can be parent has given loan to subsidiary or subsidiary has given loan to parent company. In separate financial statement, whether it is parent has given loan or subsidiary has given loan, financial asset will be recorded at amount paid plus transaction cost. One party and other party will record at proceed minus transaction cost. So one party who has given the loan, financial asset to bank, amount will be amount paid plus transaction cost. The one who has received the loan, bank to financial liability, amount is proceed minus transaction cost. If it is short term or repayable on demand, then we will not record finance income or finance cost. No IRR calculation is required. No present value calculation is required. So very simple accounting in SFS of the respective parties. Now what will happen in CFS? We are going to set off the financial asset and financial liability. And there is no question of setting off financial income and finance cost because they were not recorded only. Since finance cost and finance income are not recorded, question of set off does not arise. If it is a long-term loan, very important now, read the problem in the exam carefully. If it is a long-term loan, then the treatment will be slightly different. First we'll see situation 1. Loan is given by parent to the subsidiary. What will be the treatment in separate financial statement? First we will calculate the fair value of the loan, which will be based on market rate of interest and the agreed contractual cash flow. So one party will record it as a financial asset, the other party will record it as a financial liability. Then we'll calculate the excess amount paid by the parent. Excess amount paid by the parent will be treated as investment in subsidiary. How do you calculate that? So we'll first find out how much was the amount paid plus transaction cost, and I will deduct the fair value as we have computed above. The difference excess paid in the books of parent will be treated as investment in subsidiary. What about subsidiary? Subsidiary has received the excess. So first subsidiary will calculate proceed minus transaction cost minus fair value as per step 1. So subsidiary will treat the excess amount as equity contribution by the parent. Very interesting. Parent will show excess amount as investment in subsidiary. Subsidiary will show equity contribution from parent in the separate financial statement. Then over a period of time, the loan will be unwound in the books of parent and subsidiary. Now we'll come to CFS. In CFS what happens? One party is showing financial asset, one party is showing financial liability. So the financial asset loan and financial liability loan will be set off. Similarly, in the P&L account, one party is showing financial income, the other party is showing financial expense, we will set off, and one party is showing investment in subsidiary, other party is showing equity contribution from parent. This will also be eliminated in the CFS. Now you will ask, what about loan by subsidiary to parent? So subsidiary has given loan to parent at off market term, below market rate of interest. So step 1 will be same. We'll calculate the fair value of the loan using market rate of interest and contractual cash flow, and will be recorded as financial asset or financial liability. Then we'll calculate excess amount received by the parent. The excess amount received by the parent will be treated as dividend from subsidiary. And how do you compute it? Amount received, you just make it minus transaction cost minus fair value. The difference is excess amount. Parent will call it as a dividend received from subsidiary, because subsidiary can give dividend to the parent by charging lower rate of interest. And what about subsidiary? Subsidiary will show it as a dividend payment to the parent. Amount paid plus transaction cost is paid by subsidiary minus fair value of the loan. The difference is called dividend paid by subsidiary to parent. And then over the period of loan, the loan will be unwound in the books of parent and subsidiary. Parent will show finance cost, subsidiary will show finance income. Then you will prepare the CFS. Financial asset and financial liability will be eliminated, will be set off, cancelled. Finance income and finance cost in P&L account will be eliminated. And similarly, the dividend paid and dividend received will be eliminated. Now, next case is called ease of payment. Ease of payment means there is no date fixed when the payment will be made. So that may be between parent and subsidiary. Parent can give loan, subsidiary can give loan, or sometimes a shareholder can give loan to the company without any repayment date fixed in the contract. Then such loan will be treated as long term in nature. Such loan, which includes ease of payment, will be treated as long term in nature. This was asked in the exam also, and this you will find in our class notes also. Highly tested in the exam, and we have already discussed the accounting treatment in case of long term loan which are off market terms. Sometimes a shareholder can give loan to the company at off market terms. Then that shareholder will recognize it as investment in the entity, and entity which is receiving loan from the shareholder below market rate, that entity will recognize it as an equity contribution by the shareholder. So today we are going to stop here. We will take the lecture remaining part of this Ind AS 109 on some other day. We will announce it on our YouTube channel and our other social media. Kindly subscribe to the YouTube channel now. Keep the notification on so that you will get to know when the second part will come. So thank you very much for watching our video. Okay, so now let us continue with this wonderful Ind AS 109. Our topic is special cases of advances which are at off market terms. So already some examples we have seen. Now next is financial guarantee by the parent to the subsidiary. So sometimes the parents provide guarantee to banks or other agencies on behalf of subsidiary, then what will be the treatment of that in the books of the parent and subsidiary? Financial guarantee provided by the parent will be treated as a financial liability and classified as FVTPL. So financial guarantee will always be classified as FVTPL. We have seen earlier also. This cannot be classified as amortized cost instrument. So what are the steps that will perform in accounting of financial guarantees? Calculate fair value of financial guarantee. Fair value based on saving in contractual cash flow by subsidiary due to financial guarantee. Without guarantee, subsidiary will pay 10% interest rate, but when the guarantee is given by parent, it pays 8% interest. So this difference of 2% is the saving in contractual cash flow due to financial guarantee, and that you will convert into present value using market rate of interest or discount. That gives you fair value of the financial guarantee. Due to financial guarantee, interest charged by the lender is lower, hence saving can be calculated based on market rate and the lower rate charged by the lender. So in the exam they will give you that without guarantee subsidiary would have paid 10%, but because of guarantee it is paying 8%. So therefore the student will have to calculate fair value of guarantee by taking 2% of the saving and convert into present value. So what is the entry the parent company will pass? The parent company will pass the entry investment in subsidiary account debit at fair value to financial guarantee. This financial guarantee will appear as a liability, being financial guarantee recorded. Now on each reporting date, you have to recalculate the fair value of the financial guarantee because it is measured at FVTPL. So you have to compute fair value again. The fair value on each reporting date will be the higher of the two. First is loss allowance, that is bad debt which is expected. So on every reporting date you will see how much bad debt is expected. What if the subsidiary does not pay? How much amount parent will have to pay? And second, as usual, present value of the savings still to be realized using the original rate of interest. So every reporting date calculate higher of the two, loss allowance or PV of saving for the remaining period, and that is the amount at which financial guarantee will be recorded. Change in fair value of financial guarantee is called amortization of financial guarantee. So what I'll do, in case if the amount is lower, if the value of the financial guarantee goes down, the entry will be financial liability account debit to bank. But if the value of the liability goes up, the entry will be P&L account debit to financial guarantee, being increase in fair value, being increase in fair value, being financial guarantee amortized. So this you will do every year till settlement date. On settlement date, the financial guarantee will either become zero if subsidiary has paid all the installment, all interest and principal, then you don't have to pay anything, value will become zero, or it may become payable, if subsidiary has defaulted, then you will record it at payable value, which will be paid as per the agreement. In our class notes we have taken question on financial guarantee, so you can do the practice of on financial guarantee from the class notes. Now next special case is loan is granted on off market term other than staff advance. Staff advance we have seen, other than loan given by parent to subsidiary or subsidiary to parent. but it is still at off market terms. Off market terms means not at the normal market rate of interest. Then record such loan at fair value based on contractual cash flow and market rate. Excess paid will be transferred to P&L account. The party who is giving loan, he will transfer excess paid to P&L account. The party which is receiving the loan, excess received will be transferred to P&L account. Now comes an important discussion on reclassification. Can financial instrument be reclassified? Can a financial asset which was earlier FVTPL be reclassified to FVT OCI or from OCI to FVTPL? Can a financial instrument be reclassified to amortized cost from FVTPL or vice versa, or similarly from FVT OCI to amortized cost or from amortized cost to FVT OCI? That is the question now. So first we will see where is reclassification not allowed. Reclassification will not be allowed in the following cases. Financial liability will not be reclassified. Already we have seen investment in equity share which is designated as FVT OCI will not be reclassified. Once you choose this classification for investment in equity share, it is an irrevocable choice. It is irrevocable choice. It cannot be reclassified. Reclassification is allowed for the remaining financial asset. Following steps are relevant. So what I'll do, apply current classification till the date of reclassification. So you have to do reclassification on 31st March say 2025. Up to this date, you first do the accounting under old classification. Whatever is applicable under old classification, you do the accounting as per old classification. Then transfer current classification to new classification. And then you will pass an entry financial asset new classification to financial asset old classification. So this way reclassification will be done, but there are some important points to be kept in mind. It depends on what is the old classification and what is the new classification. Accordingly we will pass the entry. There will be some gain or loss because of reclassification. So where those gain or loss will be transferred to? If classification is at fair value, then such financial asset should appear at fair value on the date of reclassification. So if you are classifying it, the new classification is fair value to P&L account or fair value through OCI, then it should appear at fair value on the date of reclassification. What about the difference? There can be difference between book value and fair value. The difference will go to P&L account or OCI depending upon the new classification mode. If the classification is changed from FVT OCI to other category, student will remember in FVT OCI we have accumulated the change in fair value to OCI reserve. Now the balance in that OCI reserve which is already created will be eliminated by transferring it to book value of financial asset. In case the new classification is amortized cost, so that OCI reserve balance will be transferred to the book value of the financial asset if you are using new classification as amortized cost. But if the new classification is FVTPL, then the balance in OCI reserve will be transferred to P&L account. Next point is derecognition of financial asset. Again very important, highly tested in the exam. Derecognition means removal of financial asset from the books of account. Recognition means bringing a financial asset or a liability in the books of account. Derecognition means removing the financial asset or financial liability from the books of account. Now, what are the care we have to take? Derecognition should be at CFS level. That is, look at the CFS, not separate financial statement. In case of financial asset, the derecognition can be full, means the entire financial asset is derecognized, or it can be partial also. So if this is financial asset, only this part can be transferred or this part can be derecognized, possible, and this will continue to be recognized in the books. If the entity transfers part of the financial asset, then derecognition will also be partial. So very important in the exam, when can there be partial derecognition? Very important, please note down, when can there be financial derecognition? When entity transfers specifically identified cash flow of the financial asset. For example, in case of loan, these are the interest payment, plus in the last year there can be principal payment also. So these are specifically identified cash flow which can be transferred. When entity transfers fully proportionate cash flow of the financial asset, which means the entity may transfer 20% of all these cash flows whenever they will be received, proportionate transfer. Or third possibility, when entity transfers proportionate specifically identified cash flow of the financial asset, so the entity may just transfer 50% of principal amount. These are just examples, so any combination is possible. All specifically identified cash flows are transferred, proportionate cash flow is transferred, a proportion of specifically identified cash flow is transferred. So they may just transfer 50% of the interest only, that is proportionately specifically identified cash flow. In other cases, derecognition will be for the full financial asset. Now let us see condition for derecognition, highly important. When will financial asset be derecognized from the book? First situation A is when right to cash flow from financial asset expires. Right to cash flow, suppose there is a derivative financial asset and you have settled it or it has expired. Now that derivative will be derecognized. So it happens when financial asset is either realized. Suppose you have a debtor has made you the full payment. Now the financial asset will be derecognized. Suppose there is a derivative has expired, it will be derecognized. Or suppose there is a legal release by the entity. So it is commonly called settlement of financial asset. This is easy. This we are taught in 12th standard also. But now we'll see the complicated part. When the right to cash flow from financial asset are transferred along with substantial risk and reward. So first point here mentioned is right to cash flow is transferred along with substantial risk and reward or along with control of financial asset. So student will note down, either the right to cash flow is transferred with substantial risk and reward or the right to cash flow is transferred along with control of the financial asset. In that case, derecognize the financial asset. Now question is, what is substantial risk and reward? Substantial risk and reward means the buyer of the financial asset does not have legal recourse or guarantee from seller on default of realization. That means if there is a loss because of non-realization of financial asset, the buyer cannot go back to the seller and ask for money. Another point, guarantee which is not substantial is ignored for the above conditions. What do you mean by transfer of control? Transfer of control means the buyer has the ability to sell or pledge the financial asset without any restriction. So first we have seen, second we have seen transfer of risk and reward or transfer of control. The third situation, which is basically in securitization transaction, we see when arrangement is a pass-through arrangement, is a pass-through arrangement along with substantial risk and reward or along with control of financial asset. So this happens in case of securitization. Now if you have studied securitization, a company transfers the financial asset like housing loan to other company, but the customer who has taken loan from a particular entity, he will go to that entity and make the payment, and that entity is supposed to transfer the cash flow to the other party, that is SPV. Then such arrangement is called securitization. In securitization, what happens? The entity have the right to cash flow, but it has also the obligation to pay such cash flow upon realization. Meaning of substantial risk and reward is same, meaning of control is same. Pass-through arrangement means an arrangement which satisfies following conditions. All conditions must be satisfied, then it is a pass-through arrangement. The entity does not have the obligation to pay cash flow unless the cash flow is realized. Secondly, entity cannot sell or pledge that financial asset again. And third is, there is no delay in payment and realization of cash flow. So as soon as the cash flow is realized, it is given to the buyer of that financial asset. In that case, we will say pass-through arrangement is there, and if it is transferred with substantial risk and reward or control is transferred, then we will say that financial asset will be derecognized. Now we'll take some special situation of transfer of financial asset. Transfer is along with option. That means we have transferred financial asset to B, but there is a call option with A, or there may be a put option. So in that case, whether derecognition will take place or not, so you have to check whether there is a possibility or probability that the asset will flow back to the seller, that is A in this example. So if it is a call option, right to buy the financial asset again, and if it is in the money means market price of the financial asset is more than exercise price, then do not derecognize. Do not derecognize because the asset will not come back to the seller again. But if it is out of money, means market price is less than exercise price, then derecognize it because the asset will flow back to the seller. Similarly, a put option where the buyer can put back the financial asset to the seller. If it is in the money, do not recognize because the buyer is not going to sell it back to the seller. But if it is out of money, then you derecognize the financial asset. The detailed discussion we had in our class with lot of numerical examples also, but due to lack of time today, as it is a super fast revision, we are not writing the example. Another highly tested question in the exam is transfer of financial asset with a right to repurchase the financial asset. Right to repurchase the same financial asset or similar asset or substituted asset with the same fair value. So you are selling the financial asset and you want to purchase it again after some time. So we have to see whether the repurchase price is linked to market price. If yes, you are going to purchase it at a market price only, that means substantial risk and reward is transferred to the buyer and you derecognize the financial asset. But if repurchase price is fixed, it means substantial risk and reward is not transferred to the buyer. You continue to have the risk, therefore you do not recognize the financial asset, rather you just create a loan in the books. Then transfer of financial asset by creating interest rate swap. So if interest rate swap is linked to financial asset, then do not derecognize. If interest rate swap is not linked to financial asset, then you derecognize the financial asset. Now we'll see the journal entries in case of derecognition. On sale, on assignment or pass-through arrangement, the entry will be bank account debit to financial asset account, being financial asset sold. Whenever there is a derecognition by sale, assignment, pass-through, and if there is a difference between book value and the sale value, it will be transferred to profit and loss account. And if it is a factoring arrangement, then it will be presented in P&L account as a financing cost. Next is step number 1 in securitization. Highly tested in the exam. Securitization means, suppose these are interest. This is interest plus principal. So they may transfer all interest, they may transfer only principal, they may transfer some portion of interest and some portion of principal, like this. So we have to compute fair value of the strip retained, means cash flow which is retained, and fair value of the strip which is transferred. So you have to make a list of cash flow, what is transferred, what is retained, compute their fair value using current market rate of interest. Then allocate the book value. Allocate the book value based on fair value calculated above, and then you pass the respective journal entries. So what is the journal entry will pass? First we are going to pass an entry, strip in hand account debit, that is the book value that we have retained, bank account debit, that is amount realized, to financial asset book value. Being financial asset securitized, any difference will be transferred to P&L account. Same repetition, just a minute. Now next is treatment of guarantee provided on financial asset. Treatment of guarantee provided on financial asset which qualify derecognition. Whenever any financial asset is transferred, one company has transferred financial asset to another company, and financial asset classifies derecognition, but sometimes the entity also provides guarantee. The one who has transferred financial asset may give guarantee to the buyer, don't worry, we will compensate you for the loss. In that case, the journal entry for the guarantee will be P&L account debit at fair value to associated liability at fair value. P&L account debit to associated liability at fair value. Then you have to pass one more entry for your continued involvement in that financial asset. So the entry will be continued involvement asset account debit to associated liability, being guarantee recorded for information. So this will appear on asset side, this will appear on liability side, so that it will appear in your financial statement that you have given a guarantee. Amount will be the full guarantee amount, that is maximum value up to financial asset. Come to derecognition of financial liability. Financial liabilities are derecognized when either they are extinguished, that means suppose you have to make payment to a creditor, you have to pay a loan, you have paid the loan, now you derecognize, Or sometimes suppose there is a derivative financial liability and it has expired. So in that case, we will derecognize the financial liabilities. Next, financial liabilities are extinguished when such liabilities are settled. Like as I said, loan is repaid, creditors are paid, bills payable is discharged, or when the financial liability is legally released. Sometimes financial liabilities are modified or exchanged with new liability. This is very important for exam. This is called corporate debt restructuring. So you have taken a loan, but you are not able to pay. You are not able to pay principal, you are not able to pay interest, you are not able to pay installment. So then you negotiate with the lender again. The lender might reduce the rate of interest, the lender might increase the number of installment, etc. So some form of debt restructuring will happen. Now the question is, in case of corporate debt restructuring, whether we should derecognize the old liability and recognize the new liability, or we should just make some modification in the old liability itself. So following steps we will take. First we will check till the date of CDR what is the book value. So all entries you will pass, all interest you will accrue. Then based on your negotiation or restructuring, you will see what are the future cash flow and compute the fair value using original interest rate, using original effective rate. That is the rate which you have used at the time of recognizing the original liability. This new cash flow should also consider any transaction cost, because debt restructuring may involve some legal fees, some other cost, some stamp duty. Include that also in the future cash flow. Then calculate the percentage change. That is, compare your book value with this fair value and find out the percentage change. If the percentage change is up to 10%, then apply modification accounting. That means you do not derecognize the old liability, that same account will continue. But if the change is more than 10%, then we'll apply extinguishment accounting. Old liability will be removed, new liability will be created. So let us see the steps in modification accounting. Suppose the change is less than 10%, we follow modification accounting. Under modification accounting, balance carried down of financial liability should be the present value of the new cash flow with original effective rate. If it is a modification accounting, we will compute present value of future cash flow using original effective rate. Even the transaction cost which is incurred will be adjusted in financial liability. If there is any difference, it will be transferred to P&L account. But suppose it is extinguishment accounting, more than 10% change in fair value, then the old liability will be derecognized, new liability will be recognized at an amount which is equal to present value of new cash flow using new market rate of interest. What about transaction cost? Transaction cost will be written off in profit and loss account. Ledger of financial liability will be renewed. So the journal entry will be, in case of modification accounting, very important for exam purpose. They will not explain in your study material in the simple format like we are doing. Transaction cost incurred in case of modification accounting, financial liability to bank. Then if there is a change in financial liability, suppose there is a decrease in financial liability to P&L account. If there is an increase in financial liability, then P&L account debit to financial liability. So this is how you will do the accounting in modification accounting. You will not close the liability account. But if it is extinguishment accounting, old liability account will be debited at book value. P&L account balancing figure, if any, to bank transaction cost incurred, and to new financial liability will be at new fair value. You will see there is transaction cost. Student is confused. What is the treatment of transaction cost? So I have made a small summary. Okay. First, in case you want to check the percentage change in fair value, to check whether modification accounting is applicable or extinguishment accounting is applicable, in that case, while doing the testing which accounting is applicable, transaction cost will be considered in calculation of revised fair value. Second, if you are following extinguishment accounting, transaction cost will be charged to P&L account. If you are following modification accounting, transaction cost is a part of financial liability settlement. It will be adjusted in financial liability. Now we'll come to very important discussion called impairment of financial asset. In your 12th standard accounts, CPT, foundation, intermediate, you used to call it provision for doubtful debt. It is important to understand when to create provision for non-realization of financial asset and how much provision should be created. In this chapter, we will call it loss allowance. Instead of calling it provision for doubtful debt, we will call it loss allowance, and it will be shown as a deduction from the respective financial asset. On which financial asset we have to create loss allowance and on which financial asset we are not supposed to create loss allowance. Cash and bank, do not create. Derivative, do not create because it is already at fair value. Investment in equity instrument, if it is already at FVTPL, then no need to create loss allowance, and if it is FVTOCI, then also there is no need to create loss allowance. But if it is receivable and investment in debt or preference share, and if it is amortized cost instrument, then we will create loss allowance through P&L account, and if it is FVTOCI, we will create loss allowance by adjusting in OCI. So if it is FVTOCI, already we have recognized the change in fair value in OCI, but if we think that the asset has been impaired, it will be recycled from OCI to P&L account. Journal entry will be P&L account debit to OCI in case of FVT OCI, debt instrument or investment in preference share. What about FVTPL debt instrument? No need to create loss allowance because it is already at fair value. So that was a very important summary of on which instrument we have to create loss allowance. So it's basically in point number D, 1 and 2 only. Point number D, 1 and 2 only are such financial asset which requires calculation of loss allowance. So there is a simple summary chart on applicability of loss allowance. Financial asset debt measured at amortized cost, yes, you have to create loss allowance if applicable. Financial asset debt measured at FVTOCI, yes. Measured at FVTPL, no. Equity measured at FVTOCI, no. Equity measured at FVTPL, no. Financial instrument measured at FVTPL, no. Lease receivable, yes. Contract asset, yes. Trade receivable, yes. Loan commitment measured at FVTPL, no. Loan commitment not measured at FVTPL, yes. Financial guarantee contract measured at FVTPL, no. and financial guarantee contracts not measured at FVTPL? Yes. So those instruments which are already measured at FVTPL, no need to create loss allowance. Now next issue is how to calculate loss allowance amount. How much loss allowance should be created? So first you have to calculate expected credit loss, which we'll call ECL. ECL means how much expected cash flow will not be realized in future. So you have to sit down and make a judgment how much cash flow will not be realized in future, then compute the present value of the expected credit loss using effective interest rate used in amortized cost method. So suppose you believe these are the cash flows we are not going to realize, compute the present value, and this is your expected credit loss. For present value calculation, you will use effective interest rate. This is called lifetime ECL. This means this is the maximum loss you are expecting over the life of that financial asset. In some cases, Ind AS 109 allows creation of 12-month ECL. So there are two types of loss allowance. One is lifetime, one is 12 months. So what will you do in case of 12 months? You will calculate lifetime ECL as usual, but multiply it by a probability of default. If it is a lifetime ECL, we will make 100% loss allowance, but if it is 12 months, we will multiply it by a probability, let us say 20%. So I am only going to make a loss allowance of 20% of lifetime ECL if we are sure that this case falls under 12 months ECL. Now the student will ask a question, what about the journal entry? So loss allowance will be created through P&L account. Journal entry for financial asset, which is classified as amortized cost, P&L account debit to loss allowance, being loss allowance created for lifetime or 12-month ECL. But if the loss allowance is on financial asset at FVTOCI other than equity instrument, already discussed with you, we are going to transfer the loss allowance to P&L account from OCI. The entry will be P&L account debit to OCI because it is now impairment of financial asset. Student is asking me when we will create loss allowance 12 months, when we will create lifetime ECL. So you have to see whether the credit risk of default, has it increased significantly. If the answer is yes, on each reporting date check, if the credit risk has increased significantly, then we will create lifetime ECL. But if the credit risk has not increased significantly, then we will create 12 months ECL. Another question, how do we know that credit risk has increased significantly? We'll see. First you see, if there are short-term debtor or receivable, that means the amount is receivable within 12 months, please create lifetime ECL. But if it is other than short-term debtors and receivable, then we have to check whether we have to apply lifetime ECL or 12-month ECL. Those financial assets which were already credit impaired, that means which already had a bad debt risk, like one company acquires NPA from other bank, that means it is already credit impaired at the time of acquisition, make lifetime ECL. Second, those financial assets which were credit impaired by reporting date but which were not credit impaired on acquisition, even in that case we are going to create lifetime ECL, that is those which became credit impaired by reporting date create lifetime ECL. And other cases, other than these three cases, you have to make 12-month ECL. Now what is the meaning of credit impaired? Credit impaired means risk of non-realization has increased substantially, plus evidence of such increase must be there. Risk of non-realization has increased, there must be evidence that the risk has increased. And what is the evidence of credit impaired? When breach has occurred, that means the contractual cash flow is overdue for more than 30 days. Like the installment of the loan was to be paid on 30th April, but if the party has not paid till 30th May, then we'll see the breach has occurred and therefore credit risk has increased significantly. Second example is, suppose the law like under IBC in Insolvency and Bankruptcy Code has started recovery of the amount due, then we will see that credit risk has increased. And third is, credit rating has declined substantially. There are companies which provide credit rating and that credit rating has increased. So that was about impairment. Now we'll come to accounting of derivative. I had promised you in Ind AS 32 that we'll take accounting of derivative. So let us revise the meaning of derivative again as per Ind AS 32 and Ind AS 109. First is, these are those instruments whose value is derived from underlying. Second, it requires no investment or low investment. And third feature of a derivative, that this will be settled at a future date. If those three conditions are present, it is derivative. Derivatives are always treated as FVTPL instrument. Change in fair value is transferred to P&L account. If there is any transaction cost incurred, that will also be transferred to P&L account. If there is a change in fair value of derivative, it will be transferred to P&L account. So everything is routed through P&L account in case of derivative. There are various types of derivative. Anything can be asked in your exam. For example, forward, future, option, swap. Some derivatives are cash settled, like only the difference is received or paid in cash, like index future. Some derivatives are physically settled also, like for example, gold future can be physically settled in gold, or stock future can be physically settled where one party will deliver share and one party will pay cash. So now we have explained what is forward contract, but today we will not go into that. All of you know what is forward contract, what is future contract. These are some of the important features of future contract which you can stop the video for a minute and read it. How to calculate gain or loss in case of forward or future contract. If you have bought future long position, price goes up, gain. If you have bought future long position, price goes down, loss. If you have sold future, it is short position, price goes up, loss. If you have sold future, short position, price goes down, you gain. So these are some basic things you have to know in case of future contract. Similarly, you have to know some basics of option contract. How to calculate remeasurement gain or loss on derivative, very important for exam. Whether you have gained or lost in future and forward contract, our institute gives you two types of problem, and accordingly I am telling you what you have to do. If suppose you are standing on 31st March and future contract will mature on 30th June, then ideally the first preference is on this date 31st March, if I enter into a future contract or forward contract for remaining maturity, that is 3 months, how much is the forward or future price, compare with that and compute the gain or loss. But sometimes the institute does not give you what is the value of the forward or future contract for 30th June, rather they give you the spot price of the financial asset on 31st March itself, which is a wrong question, but student has to solve and come home. So we'll take the spot price, compare with whatever future contract price or forward contract price we have entered and compute the gain or loss. Theoretically speaking, this is a wrong question, or practically, but you are a student, you don't have a choice, you have to solve and come. Similarly, in case of option, we are standing on 31st March, option will expire on 30th June. So we have to see what is the premium for 30th June. What is the premium on 30th June if I enter into a forward contract today? So compare current option premium, means what is option premium if I take a option contract on this date which will mature on 30th June, and I'll compare it with my book value, that is option contract already entered, and compute gain or loss. But many times to institute, even in their study material, they have made the mistake, they don't give you the option premium for 30th June, rather they give you spot price of the underlying on same 31st March, which is a wrong question, but you can't help it, you have to solve, take it and come home. And the next is you can be given a question of interest rate swap. So calculate gain or loss on the basis of current rate and agreed rate. So this I have explained. Now journal entry for derivative. When you enter into a derivative contract and suppose you pay premium, you will pass an entry, derivative asset account debit to bank. And if suppose you receive premium, bank account debit to derivative liability. Usually in case of forward, future or swap, we don't pay or receive anything at the beginning, so no entry is passed. If there is any transaction cost, it will be transferred to P&L account. Now we'll come to reporting date. Any change in fair value will be transferred to P&L account. So if it is a derivative asset and the fair value has gone up, gain P&L account, fair value has gone down, loss P&L account. If it is a derivative liability and the fair value has gone down, it's a gain in case of liability, or it can be a loss also. So that depends on what rates are given to you on the reporting date. And then on settlement date, up to settlement date, we are going to remeasure derivative and transfer the gain or loss to P&L account. And then on settlement, if it is a cash settlement, then the entry will be bank to derivative asset or derivative liability to bank. This entry will pass in case of cash settlement. Gross physical settlement means you are going to exchange the underlying asset. So the entry will be investment account debit to derivative asset account. Investment will be brought at current market price. Book value of derivative asset will be closed. Any payment made to bank or bank account debit to derivative asset to investment. So that is about derivative accounting. Now we'll come to embedded derivative. Now we'll come to embedded derivative. What is embedded derivative? It means it is a derivative contract which is embedded in or surrounded or fenced in another contract which is called host contract. Like for example, a convertible bond. So there is a bond and there is an option of conversion which is embedded in the bond. So it becomes a embedded derivative. The option of converting the bond into equity share is an embedded derivative, and the bond is a host contract. This option is an embedded derivative. So sometimes companies, what they can do, they can merge two financial instruments into one. So the question is, what are we supposed to do? Are we supposed to treat it as one instrument, or are we supposed to treat it as two instruments and apply the split accounting? If derivative contract is not of significant value, then to keep the accounting simple, do not do split accounting. If derivative and host contracts are closely related, which means it is a general business practice, like for example, an Indian importer imports in US dollar. It is a general business practice. But a person in India, let us say in Uttar Pradesh, is doing transaction with a person in Madhya Pradesh and the invoice is in dollar. That is not a normal business practice. Then in that case we'll have to do split accounting, because two persons in India, if they are invoicing in dollar or other foreign currency, it means they are betting on dollar also. So then that dollar denominated contract will have one sale contract and one contract on the movement of dollar. Then we'll have to do split accounting. And in other cases we have to do split accounting. So if derivative is of significant value and contracts are not closely related, then we'll have to do split accounting. Reason for split accounting is that derivative will be accounted separately, host contract will be accounted separately. You cannot avoid the gain or loss on derivative by embedding into another host contract. Example of embedded derivative: contract to buy or sell in future date in foreign exchange, which is not a normal practice. Then loan with prepay option, where such prepay option is of significant value. And third, loan whose interest rate is based on index. Then in that case it is an example of embedded derivative and we have to do split accounting. Now I will give you step by step how to solve problem of embedded derivative, and in our class we have solved many questions also. You can purchase our class note with solution book which have all the example on every concept. More than one or two examples are there, or you can simply purchase our compiler which has compiled all questions of study material, RTP, MTP and exam. If you want these theory notes as it is, the way it is appearing on the screen, we have prepared a book called FR Compact, which is very simple. The way it is appearing, step by step what you have to do is presented there. Very useful for CA student, also for CMA student. So what I'll do, if there is a contract to buy or sell in future, but the contract is in foreign currency, then I will consider sale or purchase at forward rate. Sale or purchase will be recorded at forward rate. Entry for sale or purchase will be passed on actual date of sale or purchase. Secondly, we will treat, if it is denominated in foreign currency, that there is another contract to buy or sell the foreign exchange at forward rate. So this is the host contract, this is the derivative. We will treat derivative as a contract at forward rate. On every reporting date, derivative will be measured, transfer to P&L account, transfer derivative asset or derivative liability to debtor or creditor account. On settlement, what we'll do, we will transfer the derivative asset or derivative liability to debtor or creditor account. So debtor account debit to derivative asset or derivative liability to creditor, and then we'll settle the debtor or settle the creditor. So this is very important and I am sure they will test you in the exam. Now I'll come to the last part of this chapter called hedging. Hedge accounting. There are special rules for hedge accounting. Hedging means to manage your risk, to reduce your risk, to eliminate your risk by using certain instrument as risk hedging instrument. The purpose of hedging instrument is to reduce your losses, manage your losses. The loss in hedged item is compensated by the gain in hedging instrument. Loss on one will be set off by gain on other. So effectively there is no loss or no gain. So the objective of the hedge accounting is that there should not be accounting mismatch. There should not be volatility in the P&L account. Otherwise, in 1 year, you will recognize the loss on the derivative. In another year, you will recognize the gain in hedged item. So it will be just be profit shifting from 1 year to another year, but the net effect is zero. So they are trying to ensure that our P&L account does not become too volatile. Hence, they have allowed you hedge accounting. Hedge accounting will discuss few concepts. One is hedged item. Hedged item is what are we supposed to hedge. It can be a recognized asset like stock, investment, debtor. It can be a firm commitment like a contract to purchase, or it can be a highly probable forecast transaction, which means a contract which is expected in future, anticipated in future, but not a binding contract. So you may be thinking of buying a plant in foreign currency after a year, or it can be a net investment in foreign operation, that is investment in equity instrument of a foreign subsidiary. So whenever the exchange rate will change, interest rate will change, market rate will change, the value of these items will change and company will suffer gain or loss. Company will suffer loss. They don't want to suffer the loss. So therefore what they do, they use hedging instrument. So these are the 5 hedged item: recognized asset, recognized liability, recognized unrecognized firm commitment, highly probable forecast transaction, or net investment in foreign operation. And similarly you can have hedging instrument, usually derivative like forward, future, swap, option, or it can be a non-derivative contract also like investment in share, such that the gain in one will be compensated by loss in other. Derivative contract where the party is the writer of the option is not hedging. Writer cannot use derivative for hedging because writer is exposed to risk. Now there are 3 types of hedging relationship. One is called fair value hedge, where the purpose is to protect the change in fair value of asset and liability. Cash flow hedge, where the purpose is to protect the cash flow movement, like in case of floating rate bond, you may have to pay more interest if the rate of interest goes up, or it can be net investment in foreign operation, where our objective is to cover the loss arising from decline in the fair value. So for hedging instrument, for hedging of stock, investment in equity instrument, firm commitment, apply fair value hedge. Usually the institute will give you the hint whether you have to apply fair value hedge or cash flow hedge. So just see, what is my objective? Is it to manage the fair value? Yes, fair value hedge. If the objective is to protect cash flow, like debtor creditors in foreign currency, foreign loan, highly probable forecast transaction, we will apply cash flow hedge. First, follow the instruction given in the problem. If the institute says fair value hedge, you will follow fair value hedge. If the institute says cash flow hedge, you will say cash flow hedge. Accounting of net investment in foreign operation is similar to cash flow hedge. So now we'll discuss cash flow hedge and fair value hedge. Just quickly, you will pause this video for a minute and read this paragraph. Hedge conditions. Hedge condition means if you want to apply hedge accounting, then following conditions are required to be satisfied, which is a theory question. You will read on your own. Come to the next paragraph, fair value hedge, accounting of fair value hedge. If you have entered into a contract for hedge instrument, on the date of entering into contract, if there is no cash received or paid, no entry. But if any premium is paid, the entry will be hedging instrument account debit to bank as usual. If you have taken option contract, call or put, hedging instrument to bank. Usually in forward or future, we don't have to pay any premium. So no entry initially if it is forward or future. On reporting date, suppose year end has come, highly tested question in the exam. Revalue hedge instrument through P&L account. Revalue hedge instrument, that means derivative, through fair value hedge account. Open an account called fair value hedge account, or you can directly adjust in P&L account. So if there is a gain, then pass the entry hedge instrument account debit to fair value hedge or P&L account. If there is a loss, then pass the entry fair value hedge account debit or P&L account debit to hedge instrument. Now point number B is important, very important. Transfer above fair value hedge or P&L account to the hedged item. That means we are not allowing P&L account to be affected. The hedged item can be stock, investment, firm commitment, etc. So the entry will be fair value hedge or P&L account debit to stock or to investment or to firm commitment. So if you have earlier credited this account, now you debit that account and adjust that gain or loss in stock or investment or firm commitment. So your P&L account is protected, and then you revalue the hedged item as per the respective Ind AS. So if it is stock, stock will be valued using Ind AS 2, cost or NRV, whichever is lower. After passing these entries, compare cost with NRV, and if it is investment or firm commitment, then you measure at fair value using Ind AS 109. Any gain or loss will be transferred to P&L account, and then on settlement date, revalue the hedged item as per respective Ind AS, as we have discussed. Repeat the same step number 2A and 2B. Hedge instrument will be settled by realization or payment. So if there is a gain, you will get the difference. If there is a loss, you will pay the difference, and then you pass the entry for sale of stock, sale of investment or purchase under firm commitment. If it is a firm commitment, that means there is a commitment to buy, then we will transfer it to respective asset account. If the instrument is investment in equity instrument and classified as FVT OCI, then we will use OCI account instead of P&L account in the above entry, because the logic is equity instrument classified as FVT OCI, all the adjustments are done in OCI. Now I will come to cash flow hedge. In cash flow hedge, the objective is to protect cash flow. Change in fair value of hedging instrument will not be transferred to P&L account. It will be through OCI and it will be transferred to P&L account in the same year in which the hedged item will be recognized in P&L account. So as usual, if you enter into hedging instrument, no cash is received or paid, then no entry. But when premium is received or paid, the entry will be hedge instrument account debit to bank account. On the reporting date, if there is a change in fair value of hedging instrument, entry will be hedge instrument to cash flow hedge reserve or OCI. Very important, this is the only situation where we are not transferring the change in fair value of derivative to P&L account, rather we are crediting a cash flow hedge reserve account or OCI. So it will be presented in OCI. We don't want our P&L account to be affected, and in case of decrease in fair value, cash flow hedge reserve to OCI to hedge instrument. Okay, do not transfer cash flow hedge to asset account. Just keep it in the hedge reserve. It will appear in the statement of changes in equity. Hedged item will be revalued as per applicable Ind AS. On settlement, I will repeat step 2A. I will settle hedge instrument. I will receive gain. I will pay the loss, and the balance in cash flow hedge reserve which we have created will be transferred to P&L account on sale of the stock or asset if the hedge was for purchase of an asset. It goes to P&L account if it is sale of stock, adjusted in the cost of the asset if it was related to purchase of asset. If gain or loss on hedge instrument is more than gain or loss on hedged item, suppose gain is 120 on hedge instrument and loss on hedged item is 100, 20 excess gain will be transferred to P&L account. In case of hedged item in asset or liability to be settled in foreign exchange, suppose loan is taken in foreign exchange, which you have done in AS 11 also in intermediate, then we'll calculate forward point premium. That means the difference between forward rate and spot rate is called forward point premium. If forward is 80, spot is 78, then this is 2. So it will be either premium paid or difference between spot rate or forward rate. Then this will be amortized over the contract period. Entry will be P&L account debit to cash flow hedge reserve or OCI. This 2 rupees will be amortized over the contract period. This cash flow hedge reserve will automatically become 0. Other entries as per other standard will be journalized as usual. So this was Ind AS 109. Dear student, our organization is running a very important offer for student called 1 rupee loot. You can get the following books on our Vino app. You can download the Vino app from Google Play Store, or iPhone users can download from the iPhone App Store, but you have to use organization code KWUDA, and you can get access to this book only for ₹1. So thank you dear student very much, and I wish you all the best. I have tried my best to cover such a long, lengthy, complicated Ind AS 109 in about 2 hours. If I would have made it very, very fast, then you will not understand much. You can watch this video again and again, and you can get your concepts clear, revised. All entries I have given. My objective is that you should get very good result in the exam, and that will make me more happy. Thank you very much.